Good evening, students. Good evening to all of you. So, students, this is a very important topic wherein we are going to take across all the theory topics. This is for the theory topics of the non-resident taxation and the transfer pricing. Many students have requested that, sir, this topic creates us worry. It makes the things quite this thing. And that is the reason why, students, we will start directly with this theory topic which are being there. Now, what are the theory topics which are there in non-resident taxation and transfer pricing, students? That you have to look into it very carefully. Sunny, Amrita, good evening. Hopefully, Sunny, all well at your end. So, students, in this context, herein, as I have told to all of you that, students, this topic is one of the most important topic. And that is the reason why the theory topics is what we will consider it first. The topics that I am going to cover right now in the theory would be, Rupika, that is what I am taking right now. So this is the overview of the model convention. That is topic number 1. Next is your the principle and the interpretation of the tax treaty of the principle and overview and the interpretation of the treaties. Then thereafter, students, there is a BEPS, Base Erosion Profit Action Plan. Mamta, good evening. Saranya, good evening. Ujjwal, good evening to all of you, students. So the topic that we are going to discuss, students, would be, I'm just listing down the topics right now because these are the topics which students have faced immense difficulty. And that is the reason why, students, these topics are being something which I'm considering it. So the topic which I'm highlighting upon, be careful, students. Again, I'm repeating this point. Overview of model convention. Ujjwal, good evening. Second is the BEPS action plan. The third one would be the principle and the interpretation of the treaty. And then there is a one which is known as Vienna Convention. The Vienna Convention which is there. Now, students, the challenge of the students is that, sir, how to revise this thing and this becomes very difficult. It is not that way. It is, we have to split this. This part is the biggest one, the overview of the model convention. This, students, you will divide into 3 parts. The discussion, students, that you will have, you will be dividing this into 3 parts. You will say, sir, which are those 3 parts? So the 3 parts, students, which you are going to divide this particular topic would be on. In this case, the first is the definition, the applicability. This is the first slide till article number 5. This is the definition. Thereafter, the second one would be the allocation of the profit as per the model convention. And the third one would be, the 3 parts is this one. The third one is about the special provisions which are there in the UN and the OECD model convention. Okay. Meenakshi, good evening. So, students, in this context, these are the 3 parts in which we are going to do. First of all, what is this UN model and OECD model convention? So, students, in a very simple word, this is a white paper. Remember, you people would have done VAT in your IP, in your inter-CA. What you people have done it, students. What you would have done it, students. In this particular case, all of you have, students, done the white paper. All of you, students, have done the white paper in this regard. Now, many of the students will say, sir, what is this white paper which has been there? White paper is generally laying down the principles of how do you interpret the treaties and all. The white paper is nothing but, students, the principle on the basis of which the interpretation will be done. So, the UN and OECD, they have given their respective principles as to what should be the core principle of any DTAA treaty which is entered by the 2 countries. That is what this particular white paper is all about. So, let's look upon to this white paper, which is the UN model and the OECD model. These are the model on the basis of which all the DTAA has been entered between the 2 countries. Whatever are the DTAA, students, the base document on the basis of which they have entered into the treaties between the 2 countries, that base document was the UN model or the OECD model, which I am again repeating this point is nothing but a white paper. So this is not a law. This is not a treaty that we are doing it. It is a model, which is a white paper on the basis of which the treaties are being entered into. So let's look upon to this one by one. First and the foremost thing, students. So what you will say, sir, but what kind of question they will ask? Majorly, students, I feel that this can be targeted in your MCQs also. In the MCQ, students, there can be a possibility that they can target this in your MCQs. In your MCQs, students, they can ask you what, like some of the difference that this, what is the difference in the UN model and the OECD model. So my major focus would be first to make you understand what that particular article is all about. And second is what is the difference between the two. That is in the OECD model, what we get it, and in the UN model, what is that we are going to get it. So the difference also needs to be appreciated in this regard. So let's look upon to this one by one, students. So first and foremost, students, is the persons who are covered, students. First and foremost thing, students, if you want to, what the model says, that if you want to invoke the treaty, then you need to be a resident of one of the two countries. Say for example, if it is India USA DTAA, if it is an India USA DTAA, then either you need to be a resident of India or you need to be a resident of USA. Only then you will be in a position to invoke the India USA DTAA. So resident of CS, students, generally, please try to use in the theory resident of a country. Don't use the word country over here. Use the word resident of the contracting state. So they are like India is a contracting state, USA is a contracting state. They are contracting for entering into the DTAA between the two countries. So they are referred as a contracting state. So instead of country, please use the word contracting state. So the person who wants to invoke the treaty between say India or USA, he need to be a resident of either of the contracting state, namely either the resident of India or the resident of USA, as the case may be. Only then the treaty can be invoked. Only then the treaty can be invoked. Now, the most important question that could be targeted in the examination could be this fiscally transparent entity. Now, what do you mean by the term fiscally transparent entity? I have just given you, students, one particular example. I'll just again re-put up this example for better understanding. Now, please understand, what is this fiscally transparent entity? Very important point, students. Fiscally transparent entity. This can be targeted in the examination. Students, for example, in the partnership firm, in the case of a partnership firm, India consider a firm to be a separate person as compared to partners. We all know the definition of person has got a distinctive entry for a firm. So firm is considered as a separate person as compared to its partners. But when it comes to students, when it comes to various other particular foreign tax laws, they don't consider a firm as a distinct person. In fact, the assessments are not made in the hands of the firm, but the profit of the firms are assessed in the hands of the partners. So whenever there is a case of an assessment of a firm being assessed in the hands of the partners, you will find that they don't recognize that the firm is a separate entity. And if the firm is not a separate entity, therefore, this firm is considered to be what? A fiscally transparent entity. A fiscally transparent entity. Let's then take one example to understand this particular point very carefully, because this is what they can ask you in your examination. And this example is this. Supposingly, there is a firm in UK. A firm is there in UK. Okay, firm is there in UK and it has got two partners, namely partner A and partner B. There are two partners who are there in this case, partner A and partner B. Both of them are 50% share each, 50% for partner A, 50% of partner B. Now this firm has earned, say, a royalty income primarily in US to the extent of, say, for example, $1 lakh. So they have earned a royalty income in US. Now on that particular note, students, obviously you will try to invoke. So here this particular Mr. A, who is the partner, he is a resident of UK. Mr. A, who is a partner, is a resident of UK. And Mr. B, primarily, he is a resident of, say, Japan. He is a resident of Japan. Mr. B, the partner, is a resident of Japan. Now, on this particular note, students, if, as I told you, students, being a fiscally transparent entity, the UK law does not recognize the firm as an independent person. The profit of that particular firm is accessible in the hands of the partners. So accordingly, to the extent the profit is going to be assessed in the hands of the partner who is the resident of UK, only to that extent, students, the UK and USA DTAA can be invoked. To the extent that the profit of the firm is going to be assessed in the hands of the partner who is a resident of UK, only to that extent that the treaty can be invoked. This is what this particular point implies. So what does it imply, students? So out of the $1 lakh, so $50,000 is what will go to this one, and $50,000 will go to the resident in Japan. Means the partner, it will be assessed in the hands of partner B. So when you talk about UK USA DTAA, the UK USA DTAA, that UK USA DTAA only to the extent the profit of the firm attributable to the partner who is a resident of UK, to that extent only the treaty can be invoked. So you tell me, out of 1 lakh of the income, how much of the income on which the treaty, how much of the income on which the treaty can be invoked? It can be invoked only to the extent of $50,000. So when you talk about UK USA DTAA, students, this is how they will ask you the question in the examination, the MCQ questions, whatever you have to say. That the question that will be put up would be that if you talk about a UK USA DTAA, then to the extent of $50,000, to the extent of $50,000, that much of the profit shall get assessed. That much of the profit, students, shall get assessed in the hands of whom? In the hands of partner A. And therefore, only to the extent the UK USA DTAA will be invoked. So you can say, sir, what about Japan and USA? That is, again, you can say 50,000. That is a different case. But right now they will ask you the question like that. To the treaty, so far as UK USA is concerned, can be invoked by whom? By partner A, only to the extent of rupees $50,000. So this is what it implies, students. The fiscally transparent entity, when the person is not independently assessed in that country, but it is the profit of that person or the firm is accessible in the hands of the partners. So to the extent of the profit which is attributable to the partner who is a resident of that particular country, only to that extent that the treaty can be invoked. I hope that every one of you are clear with this one. So this is what is a very important question that can be targeted in the theoretical part. So that is a person cover. Now let's come to the taxes. So which are the taxes as per the treaty? What they say, which are the taxes which are going to get covered? Which are the taxes which are going to be covered under the treaty? So students, they have used the word that whatever are the taxes which are on the income, or whatever are the taxes which are on the capital. Whatever are the taxes which are on the income. Can you see that? Taxes on the income and the capital. So whatever are the taxes which are imposed on the income and whatever are the taxes which are invoked on the capital, those are the taxes on which the treaty can be invoked. My question to all of you is this, that whether, students, equalization levy, I think all of you are aware, supposingly a non-resident is paying an equalization levy under 165A, a non-resident who is paying the equalization levy under section 165A, Sunny, Amruta, a non-resident who is paying the equalization levy under section 165A, can he invoke the DTAA, say between India and USA? The non-resident is of USA, say Amazon. So on Amazon is paying equalization levy under 165A in India. So can Amazon invoke India USA DTAA for the purpose of addressing the equalization levy which is arising under the Finance Act? Can the equalization levy be subject to the treaty between the two countries? What is your take on this one, students? On equalization levy, I have asked you the question. What is your answer on this one? As far as the equalization levy is concerned, whether the treaty can that be invoked? To that the answer is no. To that the answer is no, students. And why is it so? Because equalization levy is not a tax arising on the income. Equalization levy, students, as you all are aware, is not a tax which is imposed on the income. I hope that all of you are clear with this one. So therefore, in this case, for equalization levy, you cannot refer the treaty. As simple as that. So students, in the July 2021 attempt question, beautiful question, a beautiful question was being targeted. And many students really got stumped with that question. July 2021 attempt. Are you aware of that? So there was a particular person, he was a resident of India and he was earning a salary income in US. He was earning a salary income in US. In US, students, the income tax is imposed by both the central government as well as the state government. Are you aware of that? Income tax is imposed by, because in India we have got the union list. In the union list only the income tax is charged. In that US it comes in the concurrent list. So therefore income tax is charged by the federal as well as the state. So they have used the term, 3 taxes was given in the question, and the 3 taxes was federal tax, state tax, and the third one was the social security tax. There were 3 taxes which was being referred. One is a federal tax, means the central, the state tax, which was the state government, and the third one was the social security tax. So the question that came up was, which are the taxes that will be considered for the purpose of the credit? So what are the taxes on the income? The taxes on the income was only the federal tax and the state tax, because these 2 taxes are where the taxes on the income. Whereas the social security tax, the third tax which was being mentioned in the question, was not in the nature of an income tax. And because it was not in the nature of an income tax or tax on income, therefore no credit can be given so far as the third tax was concerned. So the credit would be applicable only in the case of the 2 taxes on the income, which was the federal tax and the second one was the state tax. But the third one being, which was third one, the social security tax, not being the nature of an income tax, it was not eligible for any credit. This is what, students, the taxes covered was considered. ICI you should appreciate and you should really bow down. This is what ICI does in the examination. So you have to be very clear about the concept so that you can apply this particular provisions very carefully in the exam. Now students, as we have discussed some time back, that you need to be a resident in one of the 2 countries. You need to be a resident in one of the 2 countries. So you need to be resident of either of the contracting state. You need to be resident of either of the contracting state. Only then you will be in a position to invoke the treaty. So that is the importance of the resident. Now students, in this context, who is a resident of a contracting state? That is a definition that has been given to you. Who can be considered to be a resident of a contracting state? So see the definition given in the OECD and the UN model. The definition says, any person who under the law of that state is liable to tax therein by reason of. Liable to tax. Remember students, liable to tax. We have used this concept of liable to tax, students, also in the determining the residential status. And that was when we were discussing section 6(1)(a). In that also their liable to tax was being referred in. So liable to tax, and that is also being explained by virtue of the Finance Act 2021. Let me ask you this question, if you can recall that discussion which we had earlier. Supposingly in a particular country, that particular income is chargeable. However, there is an exemption which was being given on that particular income. Income is chargeable, but the exemption was given on that particular income. Can we say that this particular income is liable to be taxed in that particular country? Although after the exemption, the tax liability becomes nil. So is he liable to tax in that particular country? Because if you say, yes sir, he is liable to tax in that country, then as per the article number 4, they can consider that person to be a resident of that particular contracting state. What is your take then? Can he be considered to be a resident of the contracting state by virtue of having an income which is liable to tax in that country in this particular example? Is he liable to tax? Very good. Saranya, Sunny, Mamta, Amruta. And the answer is yes indeed. Yes indeed, students. Excellent. Very good. He is liable to tax, although he is not liable to pay the tax. There's a difference between the two terms. I am repeating this for the last time. Liable to tax versus liable to pay the tax. So yes, he is liable to tax, though he is not liable to pay the tax. Is that clear to all of you, students? All of you are clear with this one? Excellent. Very good. So this is how the things has to be looked upon. Now then, students, they have said that he can be liable to be taxed. He is liable to tax on account of, say, domicile or maybe his residence. Because of that, like he is staying in that country for that many number of days. So therefore, he is liable to tax. In India, we all know how being a resident, you are liable to tax because then your world income becomes chargeable under this act. So therefore, you are liable because of the residence. And say maybe place for a company, if you talk about for a company, then maybe if a domestic company which is incorporated in India, that is always considered to be a resident, and therefore their world income is liable to tax in this country. Whereas if in this context, so this is how we have to consider it, isn't it? So these are because of these criteria, if you are liable to tax in that country, you could be considered as a resident of that contracting state. So they are just giving you the parameter as to how we will look into whether you are a resident of a particular contracting state or not. This is what the UN model and OECD model tells you, that this is the criteria to look upon as to whether you can be considered as a person who is a resident of that contracting state. That will depend upon whether you are liable to tax on account of any one of this following criteria which we have discussed just now. At the same time, students, the ICI, you can always understand, they have used this term. That this term, which term, students? The term resident of contracting state. This term, however, does not include any person who is liable to tax in that state in respect of only the income. In respect of what? Only the income from sources in that state. Only the income from sources in that state. What does it imply, students? Supposingly, I am a non-resident. I have got an income in India. I am a non-resident and I have got an income in India. And because the source of my income is in India, therefore what? Therefore, I become liable to tax. So just because my source of income is in India and therefore I am liable to tax in India, will that make me as a resident of India? Will that make me as a resident of India? Answer is no. That is what the treaty says. So just because you have a source of income and therefore you are liable to tax in that other country, that will not make you a resident of that contracting state. So what are the criteria? So criteria is never the source of income. Please be careful. I am drafting your MCQ for your upcoming May 22 attempt, and I am already clearing what kind of question, students, you can expect in the examination. So one of the question would be that whether this would be the factors that will be considered as being a resident of the contracting state. This can be considered as a fact. Can this be considered as a factor to become a resident of the contracting state? You will be given in your MCQ question like residence, domicile, place of management, and the fourth option I will give you. What is the fourth option which I'm going to give you in the question? Source of your income in that state. And which is the incorrect out of the four? It is the source of the income in that state. This cannot be the criteria for becoming the resident of the contracting state. Congratulations, students. You already came to know one of the question in your upcoming May 22 attempt. Nothing like that, isn't it? So this is what it would be, students. Now, as I told you, students, and I'm repeating it again, you don't have to buy at anything. The theory topics of the international taxation and non-resident taxation, students, one thing you just take it from me. Please don't buy heart it. It is pointless. You just only need to appreciate what exactly this term means. Because my question which I'm expecting in your examination is either the question relating to the question which I'm expecting in the examination, students, is either the question which is relating to the MCQs and all. MCQ does not require by-hearting. It just requires the understanding of the concept. And second is some they can ask you also some 4 to 5 marks of a independent theory question. Even on that, you don't need to by-heart. Simply take it forward. Permanent establishment. This is one of the very important concepts, students. The concept of PE. Concept of PE, students, all of you are aware. This concept of the permanent establishment as per the article number 5. As per which article? Article number 5. Can you see this article number 5? Article number 5 of the UN model and the OECD model is important because a business profit, if at all it has to be taxable in the country of source, a business profit, if at all it has to be taxable in the country of source, for that particular purpose, students, you need to be a resident of one of the two contracting state. You need to be a resident of one of the two a business profit, if it has to be taxable in the country of source, it is important that the permanent establishment, it is important that the permanent establishment of that person should exist in the country of source. So only if that the permanent establishment of that person exists in the country of source, that we will say that the business profit of that person, the business profit of that particular person, students, will be taxable in the country of source to the extent it is attributable to the permanent establishment in that particular country. To the extent, not the world income, but only to the extent the profit is attributable to the permanent establishment situated in the country of source. Is that clear to all of you, students? All of you are clear? So therefore the curiosity comes as to, sir, what is then the concept of P? That is a curiosity to all of you. So the P as a concept, students, means a fixed place of business. There has to be a place of business, and that place of business should be fixed. There has to be a place of business in the contracting state, and that place of business should be fixed. And only when you have a place of business which is fixed in the other contracting state, that we can consider as having a presence of P in the other contracting state. That we can consider that there is an exposure of the P in the other contracting state. Now P, what do you mean by P? Therefore, what are the fixed place? What could constitute a fixed place of business? What can constitute, students, a fixed place of business? So a fixed place of business can be my branch, my office, my factory, my oil gas well quarry, my workshop, my world. Isn't it, students? And that exactly is the point. So if you have got your branch, your factory, your office, your workshop in the other particular contracting state, then indeed you will be set to have an exposure of, a P in the other contracting state. That is what will give rise to the exposure of the P in the other contracting state. Is that clear to all of you? All of you are happy in your life, students? Sir, with articleship, how can one remain happy? That is also a good point, students. That is also a good point. Anyways, hopefully those days, students, would not last long, isn't it? And you will qualify very soon as a chartered accountant, and then we will see whether I'll ask you the question thereafter also. That, are you happy in life? And let's see what would be your answer. And then at the end of your journey, you will realize that happiness is state of mind. That is the ultimate truth, students. Happiness is what? A state of mind. Write it, most important question of your life. Get busy living or get busy dying. Don't consider that this moment is not the moment which you something wanted to be. If then the next moment also, this is all about the attitude. Even the next moment also, howsoever it may be favorable, you may become a chartered accountant, But if your attitude is not conducive to live in your present, then irrespective of primarily any kind of a moment of your life, you may not primarily be happy. So it's always a state of mind, students. Keep that in mind. Let's start, students. Now, one of the very important part is the agency P. So all of you agree to this proposition. One of the very important parts, students, is about the expansion of the scope of P. As you all know, students, in the business connection that we have in our domestic law section 911, we have discussed that because of a business connection in India, the business income of a non-resident will be taxable in India. That is what we have discussed. Because of the business connection in India, the business income of the non-resident will be taxable in India. This is the proposition, students, that we have discussed, isn't it? So business connection, if you know the definition that we have discussed in our earlier session, we have seen in our earlier session, students, that the business connection includes the agent who is wholly or mainly is performing any of the following activities. That agent who is in the source country and who is wholly and mainly performing any one of the following activities will also give rise to the non-resident a business connection in India. So that concept of an agent connection, will it give rise to a business connection? That we have seen already. Similar is also the definition of PE. As per the definition of PE, they have expanded its scope also towards what, students? Towards an agent who is there in the source country, an agent, students, who is there in the other contracting state, and that agent is wholly and mainly, please students, I'm emphasizing on this point, wholly and mainly. That agent is wholly or mainly performing what? A principal role which is leading to the conclusion of the contract. That agent is wholly or mainly performing a principal role which is leading to the conclusion of the contracts. So because of that principal role that the agent is performing, which finally results into the conclusion of the contract, therefore even that particular principal role which is getting performed will give rise to a business connection to that particular agent in the other contracting state. Sorry, it will give rise to a business connection to that particular person in the other contracting state. Now, in the treaty, students, the agent who is wholly or mainly performing the activity on your behalf, that particular agent is referred as the dependent agent. That agent is referred as what? A dependent agent. So therefore, this could be a very important question, that whether a dependent agent will result into a permanent establishment of the person in the other contracting state. Whether a dependent agent, will it result into the existence of a permanent establishment in the other contracting state? The answer could be yes, it could be. So therefore, the dependent agent should be distinguished with an independent agent. Then can you tell me what could be the definition of an independent agent? Now this can be an important distinction that they can ask you in the examination. An independent agent, students, is an agent. An independent agent is an agent who is neither wholly or mainly performing the activity on your behalf. So that particular agent is also doing the work for you, but he is not wholly or mainly doing the work for you. He is also doing it. For others also is doing it. For you also is doing it. If that is a kind of a person you have appointed in India who is not wholly or mainly performing the activity for you, but he is also performing the active for you. Please understand the distinction. Are you getting the distinction? Distinction between the two. A person or an agent who is wholly or mainly performing the activity on your behalf versus a person who is also performing the activity for you. So the second category of a person is referred as an independent agent, whereas the first category is known as a dependent agent. Dependent agent means that agent is completely or mainly performing the activity on your behalf. So it is the first person that is wholly or mainly performing the activity on your behalf will give rise to a P exposure in the other contracting state. Will give rise to a P exposure in the other contracting state, whereas a second category of a person will not give rise to a P exposure. So that is the point that you should always be clear about it. So this is what the Article 5 says. Now students, please be careful in the context of your domestic law, section 911, if you know business connection article that we all have referred. In the case of a business connection article, students, we have discussed this particular point quite a time again and again in section 911. And what was that? In 911 that we have discussed? If you can recall, students, in section 911, we have discussed this particular point, that if a person, an agent who is independently performing the activity in his normal course of business, then this will not give rise to a business connection. So therefore, that business connection definition wherein the agent who is independently in the normal course of his business is also performing the activity for you, that does not give rise to a business connection. So therefore, both the domestic law and the treaty or the model convention, they are at par. They are at par, or at least on this particular point. Can we say that? Yes. So just be very careful, students, over here. And therefore, students, this is what it is. I hope that all of you are clear with this one. If you all are clear, students, then do ensure to like this video, and also please share this video, students. This is such an important topic that has been done. Share it across it wherever you can, and that is my only request to all of you. Have you all understood any query? Your part 1 is over. Part 1 of the overview of model convention is over. So you should revise this particular topic into 3 parts. Hardly, students, now you'll say, sir, but when we revise it, we should not have, we actually are finding it difficult that it takes a lot of time. How much time, students, you think now it will take if you have to revise only this one part? I will say only 5 minutes. Can I say only 5 minutes? So it is only 5 minutes, students, that will take you. So if you know how to revise it, students, you can easily, without revising it, actually you can revise it. So you can allocate 10 minutes and finish it off one part. But you should know what you're doing it. If you know what you're doing it, students, you can easily trade off. Now I come to the second part. Now what is the second part? In the second part of the UN model and the OECD model, in the second part of the UN model and the OECD model, students, what do we get? Here you are going to get, students, the distinction. Now here in the second part, you can write in this whatever we are going to discuss. In your examination, you will get the question based on comparison. So here you are going to get the question based on the comparison. Whereas in the first part, you will only get the question on some meaning, some outright theory they will ask you. In the first part, what we have discussed. But here in your examination, you will expect a question based on what is a comparative point on this particular part so far as UN and OECD model is concerned. Here you will get the comparison. So what is that second part? Now, they say that the treaty which will be entered between the two countries, the treaty will provide how an income will be given the right to tax to a particular country. On what criteria or on what basis there will be a right to tax on a particular income to a particular country. There are only 2 countries which we all are aware. Which are those 2 countries? One is a resident state and another is a contracting state. Which are those 2 countries that we are talking about it? The right to the resident state to tax the income versus the right of the the right of the resident state to tax that income versus the right of the source state to tax that income. So therefore, this following particular article are highlighting upon under what circumstances the right will be available for the contracting state to tax that particular income. Which income? Starting with the first income, business profit. Which income? Starting with the first income, business profit. So how a business profit? So of a person who has earned a business profit in the other contracting state, that is in the source country, which country will have the right to tax? So this is about allocation. This particular part 2 that we are discussing it right now talks about how to allocate the taxation right between the resident state and the source state. How do we allocate the taxation right between the resident state and the source state? Starting up with the first one, that is the business profit. So what about the business profit? So when you talk about the business profit, students, one thing they will always start up with, that the resident country will always have the right to tax this particular income, because obviously the world income is taxable. So students, here the resident country always has generally the right to tax this income as per the UN model and the OECD model. But the entire curiosity is when the source country where that income is actually earned, when the source country where the income is actually earned will get the right to tax that particular income. We are more curious to know about that particular point. When the source country where the income is actually earned will get the right to tax that particular income. Now you can tell me, students, for a business profit, resident country is like given that it will always have the right to tax that particular profit. But what about a source country? When a source country or a source state will have the right to tax that particular business profit, when they will get the right, students? Can you tell me, students? And indeed, if the source country has got what? Has the permanent establishment of that particular person situated in that particular state, only then the profit which is attributable to such PE will become taxable in that source state. All of you agree to this one? So far as a business profit is concerned, the business profit could be taxed in the source. Business profit of a person could be taxed in the source country if the source country has got a permanent establishment of that person. Then in that case, whatever is the profit which is attributable to that particular PE of that particular person in that source state will be the basis or the factor of taxation. The PE existence. So obviously the PE is there. So that is what it is saying, that once the PE is proven, the source state can only tax such profit as are attributable to the PE. As I told you, the PE exposure is the key. Only then the business profit, students, can be taxable in the source country. I hope that every one of you are clear with this point. No one has got any confusion whatsoever. Now be careful. This is your examination question now I'm discussing with all of you. Please pay attention to your examination question. Are you ready for your examination question now? As I told you, in this particular part of the overview of the model convention, you are going to get comparison. So one of the comparison that can be targeted could be about the business profit. The taxability of business profit. The taxability of the business profit in the source country as per the OECD model and as per the UN model. This is your May 22 question. Get ready, students. The May 22 question, and the question would be the taxability of the business profit in the source country as per the OECD model versus the UN model. So OECD model, I have told you. What is the OECD model? OECD model, I told you that a particular business profit of a person will be taxed in the source country. A business profit of a person will be taxable in the source country if that person is having a permanent establishment in that source country. If that person is having a permanent establishment in the source country, then whatever is the profit which is attributable to that particular person in the source country, to the extent of such particular profit, the amount will become taxable. To the extent of such particular profit, the amount will become taxable in the source country. The UN model, students, the UN model also says the same thing, that if the person is having a permanent establishment in the source country, then to the extent of the profit which is attributable to that particular permanent establishment in the source country, that much of the profit will be taxable in the source country. So the source country will have the right. But here lies the most important point that distinguishes the UN model with the OECD model. UN model also introduces a new particular concept of the force of attraction rule. The force of attraction rule. The FOA, the force of attraction rule. What is this force of attraction rule? It means, sir, attraction. Yes. What kind of attraction? Let's have a look. I'll give you an example only to explain this particular point, students. Say for example, there is a UK departmental store. That UK departmental store has set up a branch in India. That UK departmental store has set up a branch in India. Now everyone will admit that this branch in India give rise to a permanent establishment in India, and therefore whatever is the profit attributable to that particular branch, whatever is the profit which is attributable to that particular branch will become taxable in India. Will be taxable in India. Every one of you agree to this one? Yes. Now, in India, obviously this branch became very popular, and accordingly across India, length and breadth, everyone came to know about this branch. Now many people could not, obviously they were staying in different city, but they could not, obviously that branch was only in Mumbai, and many people who were there in Delhi, in Chennai, in Bangalore, they could not come to that branch, obviously because of the logistics issues. So what these people did was that they in fact directly contacted the UK departmental store through their website. So they went to the website of the UK departmental store, and in the website itself of the UK departmental store, not of Mumbai, of the UK departmental store, they started purchasing what? The goods. How they purchased the goods? They were placing their order. They were accordingly making the payment in that website, and accordingly the UK departmental store was dispatching these goods from UK. Dispatching these goods from UK. Now the question arises is that the goods which were being dispatched from UK to the customers who were located in India, obviously these customers were not approaching the branch. They were in fact bypassing the branch and directly ordering the goods from the UK departmental store. Now if you see, so far as the OECD model is concerned, they will say that this profit which the UK company has earned from the buyers in India directly approaching to the UK company that is based in London, that particular profit will not be taxable in India, because only that much of the profit which is attributable to the PE, only that much would be taxable in India. So the OECD model will not allow the taxation of the profit arising from the transaction which the Indian customers or the Indian buyers were doing directly through the London branch. But the UN model gives that flexibility or expands the scope. And what is the expansion of the scope? They say that apart from the profit which is attributable to the Indian PE, which is the branch in India, also what students? Also that particular profit which is arising from the sale of goods or merchandise of same or similar kind as those which are sold through that PE. So if there is a sale by the person who is selling the same goods or a similar goods to the source country customers, which are same and similar as compared to what is being sold in the PE in India, so to that extent there is a attraction primarily which is established, and accordingly even that particular sale transaction would become accessible under the act, but that is a source country. So even that sales transaction which is undertaken by the customer in India directly from whom? From the London branch, will also be accessible under the source country taxation law. This is what is the force of attraction rule. So force of attraction rule is used only in the UN model, as per which not only whatever is directly purchased or sold from the particular Indian branch will be accessible, but also the person who has the UK company which has sold same or similar kind of goods to the Indian customers in India will also be accessible under what? Under the jurisdiction of the source country. So the source country will have the right to tax even that particular income. Is that clear to all of you students? This is the force of attraction rule, which is used only in what, students? Only in the UN model. It is not used in the OECD model. I hope that all of you are clear with this one. Any doubt on this force of attraction rule? If not, then let's proceed further. Let's wrap it up the other things quickly. All of you are clear with this one, students. Please tell me. If you are clear, then shall I move to the next article? Now, students, the next articles are in respect of the passive income. Which are the passive income? Like interest, royalty and FTS. So, interest, royalty, FTS and the capital gains. So, the passive income, namely interest, royalty, FTS and the capital gains. So, let's discuss the taxable right. So, there is hardly now you will not find any difference, at least on interest part. This article will not give you any difference. So, I don't expect any question that will be targeted over here. So, what they say? They say, it simply says that interest income, supposedly a US resident has earned an interest income in India. So obviously they will say that, okay, because you are a resident of US, so the resident country will always have the right to tax that income. And in this case, they have also said that the same income may also be taxed in the country of source. Students, the same income may also be taxed in the country of source, but what they have done in all these passive income is that they have given an upper rate of tax, that the rate of tax in the country of source should not exceed a particular percentage. The rate of tax should not, in the country of source should not exceed a particular percentage. This is what they have done it. So they have given the right to tax this passive income in the country of source, but they have ensured that such income which will be taxed, which income we are discussing right now? Interest income. Such income that would be taxed in the country of source should not be taxed at a rate which is beyond this particular rate, the specified rate. Now the rate they have not given you in the model. Obviously that is left for the country to decide in the treaty as to which is the upper limit rate that could be taxed in the country of source. Which is the upper limit that could be taxed in the country of source. That is what you will get it therein. Is that clear to all of you, students? So here there is not much of this thing. And that is the reason why, students, you will find, see, this is what it is. Please understand. The structure of our domestic law, if you allow me 1 minute discussion on this. The structure of your domestic law. The government, the way we are reading our Domestic Income Tax Act 1961 is based upon how the government have entered the treaties. And knowing the fact that in the treaty, they provide a restriction that yes, these passive income can be taxed in the country of source. These passive income can be taxed in the country of source, but not at a rate going beyond this. And that is the reason why, students, you find that under the domestic law or the Income Tax Act, we have seen section 115A. We have seen section 115A, and you will appreciate that in 115A, we have got a list of all the passive incomes. Starting with dividend, interest, royalty and FTS income. So in all that section, what all 115A does is give you the rate of tax on these income of a non-resident which will be assessable under the Act. And also we know that this will be assessable at the gross basis. That is not on the net basis. That is without any deduction of any expenditure. So the structure of our Income Tax Act providing for the rate of tax for the non-resident in respect of such passive income, this structure, students, has been made because of the way the treaty provision provides for the taxation of these passive income in the source country. And that is precisely how we have made our structure of our taxation. Is that clear to all of you? And hence you will find that even in 115A, we have got dividend, interest, royalty and FTS getting taxed at a particular rate. And this is what it is. And hence, if you can recall, we have discussed that the rate under the Act versus the rate under the treaty, whichever is more beneficial, isn't it? That is what we used to discuss in all our case studies. Also earlier in the past, we have discussed this particular point. The rate under the Act versus the rate under the treaty, whichever is more beneficial, would be considered for the purpose of deciding as to what will be the rate of tax. This is what is your article number 11, students. This is what is your article number 11. So I don't feel that this could be targeted. Now, what is the meaning of interest income? They have told you, you can skip this. Students, you can skip this one. Now comes the most important theory question on this. The OECD model and the UN model so far as the taxation of royalty income is concerned. How a royalty income of a person is dealt under the OECD model and under the UN model. So far as OECD model is concerned, they are very categorical to say that the royalty income will exclusively be taxable only in the country of resident. Students, one thing you should realize, that the OECD model generally are being made for the developed country. The developed country are the one who are the beneficiaries of the OECD model, whereas the UN model is for the country like us, the developing country. So what, and those like the developed country prefers to enter into the treaty based on the OECD model, whereas the developing country like India, we prefer to enter into the treaty as per what? As per the UN model, because it protects our right to tax a particular income of a person, a non-resident. So the OECD model says that if any treaty is based on the OECD model, then that treaty will give an exclusive right to tax the royalty income only to the country of resident. So country of source can do nothing. Country of source, students, in this particular case can do nothing. However, UN model, so you can see a distinction. Can you see that one? OECD model. OECD model is for developed country, and resident RS is the resident state. The resident state has the exclusive right to tax the royalty income. What about the developing country? The UN model convention. Royalty may also be taxed in the source state. So definitely, when you know in 115A we have tax royalty income. Do we tax royalty income or not? Under the Income Tax Act, yes. Of a non-resident we do tax the royalty income. So what would be our preference when we enter into the treaty? What would be our preference? That the treaty should be based on what? UN model or OECD model? Has to be the UN model. Because then in the UN model, the source country will get the right to tax this income. Because if any treaty, if we have entered because of some compulsion, we have to in fact enter that treaty as per the OECD model, then what will happen? That royalty will get exclusively taxed only in the country of resident, but not at country of source, which is India. So therefore India will have to give up that right to tax, even if under the domestic law, such royalty income is taxable, because we know that ultimately the treaty will prevail. So if the treaty will prevail, then in that particular case, any treaty which India would have entered as per the OECD model, in that case the treaty will finally prevail, in which case we have to give up our right to tax that particular royalty income as per the treaty provision. So India will never prefer OECD model, but yes, because of some compulsion we have to enter that treaty. That's a different story altogether, but otherwise all the treaties are based on the UN model. I hope that all of you are clear with this one. Now again the same thing. The UN model allows the source country to tax the royalty income, but obviously they will also tell you that the rate of tax in the source country on such royalty income should not exceed a particular threshold amount. The rate of tax in that source country should not be taxable a particular threshold amount. Is that point clear to all of you? Is that point clear to all of you, students? And that exactly what it is. Royalty definition, students, you can just skip all these things. All these things we have done it. Remember that one of the case law we were discussing, engineering companies, about the computer software and all. So those are the things that we discussed. Definition part you can skip. What you have to read for your examination purpose, students, this is where you need to focus. Come to fees for technical service, FTS income. Now again one distinction, students, very important distinction. Can you see that? Here students, for FTS income, students, UN Model Convention has inserted a specific article pertaining to FTS. So UN Model Convention has got a particular article on FTS, but there is no specific reference of FTS in the OECD model article. Students, by the way, before I come to the Model Convention, just visualize our Income Tax Act. In our Income Tax Act, do we treat FTS as a separate income? as compared to the royalty income or the business profit? Do we consider this FTS income, fees for technical service income, as a separate income, as distinguished from royalty, as distinguished from the business profit? Answer is yes. We treat FTS as a separate article. But just imagine now, UN model now has got a specific article on FTS. And what would be the specific article on FTS? That yes, the source state will also have the right to tax the FTS income, but definitely not at a rate of tax going beyond a particular threshold. But not at a rate of tax going beyond a particular threshold. This is what the OECD model, this is what the UN model will say. That the source state will have the right to tax that particular FTS income, but not at a rate going beyond a particular threshold percentage. How about the OECD model? In OECD model, it is silent. OECD model, students, is silent. All of you agree to this one? OECD model, students, is completely silent about it. Do you all agree to this one or not? And because now that the OECD model is completely silent about it, it creates a lot of suspense. Students, now it creates a lot of suspense. If any treaty is entered based on the OECD model, then how this FTS income will be taxable is my question to all of you. How this FTS income will be taxable is my question to all of you. As far as the Indian domestic tax law, we have got specific provision which taxes the FTS income. But the larger question over here is, under the treaty, because obviously this will enter into the treaty because of the fact that there would be a double taxation. That same FTS income would also be taxed in the domestic law of the non-resident in their country. So therefore that there will be double taxation, and then you will enter into the treaty. Now when you enter into the treaty, the question will be, under what article that the FTS income will be considered for deciding which country will have the taxation right. Under what article now we are going to refer? Deciding the taxation of FTS income as to which country will get the right to tax that particular amount. If the treaty is entered on the basis of the OECD model. If the treaty is entered on the basis of the OECD model. Can you say that? Anyone? What could be your answer, students? How a FTS income will be dealt in the treaty which is entered based on OECD model? And the answer to that, students, is be careful. In that case, the FTS income, Sunny, in that case, the FTS income will be treated as what? As a business profit. FTS income will then be considered any treaty which is based on the OECD model and there is an FTS income earned by a person in the other contracting state, in the source state, then that FTS income will be considered under a business profit, because there is no specific article. If there is no specific article, where it will go? It will definitely go under the business profit, because ultimately it's a business income. And therefore it will go under the business profit. And in the business profit, you all are aware, OECD says what? OECD says that the business profit will be taxable in the contracting state, in the other contracting state, which is a source state, only if there is a existence of the PE. So the FTS income, which will be considered as a business income under the OECD model convention, will be allowed to be taxed in the other contracting state, which is India, the source state, which is India, only if what, students? Only if that the non-resident has got the permanent establishment in the other contracting state. I hope that every one of you are clear of this one. So this is a unique point. So the distinction in the FTS article, students, how you're going to sum up this one? Royalty income, OECD, exclusively only with the, so there is a specific article. Yes, there is a specific article in OECD as well as in UN model convention. But in the OECD model, the royalty income is exclusively taxable only in the country of residence. So far as the FTS is concerned, in the FTS, there is no specific article as far as OECD is concerned. So because of the absence of any specific article in the OECD, the same particular FTS income will be dealt like a business profit, and accordingly the taxability of the FTS will be decided as per article number 7, which is in respect of business profit. I hope that all of you are clear with this one now. Now the next particular point, students, is about the capital gains. Now what about the taxation of the capital gains, students, in this context? Now if you talk about the taxation of the capital gains, students, this is what it will be. Now the capital gains, students, it is very clear. Here it's very simple thing. The right of contracting state. Now they have said that let's decide. This is a very simple thing, students. Here it is very simple thing. Yeah, provided, sorry, it is in the nature of a business income, because then there is an article on other income also. So obviously whenever there is a case of a business income, when you think that if not this, then can it be considered as a business income or not? If it can be considered as a business, because it's an activity of business, technical service, so it will go under that particular category. Okay. Now capital gains, if you talk about it, students, this is a very simple article. What they have said, let the country decide between each. Students, let the country decide between amongst themselves as to how they want to tax this capital gains income. So there is nothing which is special about this one. Both OECD as well as UN model says that the country to the agreement will decide about the manner in which the capital gains arising in the other contracting state, that is a source state, how it will be taxed. So we have got very unfortunate cases of our past. The past is haunting us, students. The India-Mauritius agreement. Are you aware of that particular the most terrible times of the India-Mauritius agreement, wherein we have given the taxation right in the treaty between India and Mauritius to the capital gains which is earned in India, which was a source state. The taxation right was given to the resident state, which is Mauritius. And in Mauritius, what we see? Capital gains rate of tax was 0. So therefore, it was giving rise to a double non-taxation. But that is how it was. That is how it was, students. And therefore, this is what it is, students. That for capital gains, they have said that let you all decide what is comfortable to you. Whether you want to give the right to the source country to tax it, or whether you want to have the resident country having an exclusive right to tax it. Let you decide in the agreement how you want to tax the capital gains. Coming to this one, students, independent personal service. Now, what is this independent personal service, students? It's a professional income. Now, professional income, students. Now, again, a very important point. You can get MCQ question here also. Now, again, there is an absence of a professional income article. There is an absence of a professional income article so far as OECD is concerned. There is an absence of a professional income article, that is independent personal services, which is nothing but a professional income. Independent personal services is nothing but a professional income. I will say this to be a professional income. So, as far as this article is concerned, there is an absence of, there is a complete absence of what? Of the OECD article on professional income. Why? Because they say that we don't distinguish between professional income and business income. We don't distinguish between professional income and business income. So therefore, even the professional income as per the OECD model will be dealt as per article number 7. What is article number 7? Article on business profit. Article number 7 as per the business profit. But what about students in this context of the UN Model Convention? The UN Model Convention has got a specific article that the professional income, we will allow this to be taxed in the source state, which is the country in which you are earning this particular professional income, provided. Now, please understand, this is just a jugglery of the words. Business profit is taxable in the source country if the person has got a permanent establishment in the source country. That is a criteria. Here, UN model is telling that an independent income arising out of an independent personal services in the source state will be taxed in that state where it arises, provided the person should have a fixed base. They have given you two criteria, as per which, on the basis of which the professional income will get taxed in the source state. The first criteria being fixed base. So if this person who is providing an independent personal services in the other state, that is a source country, then this professional income will be taxed in the source country only if they have got what? Only if they have got the fixed base in the source country. Only if they have got a fixed base in the source country. The second criteria is that if they don't have a fixed base, so first one is about the fixed base. So first one is about what? Is about the fixed base. So if you have got a fixed base, then the fixed base will decide. So in that case, yes, then the professional income arising out of this particular services will be taxed in the source state. But if you don't have a fixed base, then what? Then they say that still it could be taxed in the source state if what? If this person stays in the source state for a period of minimum 183 days or above in the last preceding 12 months. So if the stay is in the source state, SS is a source state, is for minimum 183 days, then in that case also we will say that this particular professional income will become taxable in the source state. Is that clear to all of you students? All of you are clear with this one? Every one of you? And that exactly is the point. Other income, irrelevant. You can just read it, forget it. This is your end of part 2. So I've told you that this chapter, you will revise it in 3 independent parts. The part 1 ends till permanent establishment definition. It is all about the definition and the applicability. Part 1. Part 2 is about the allocation of the taxing right. That is your part number 2. And part number 3, students. And part number 3 is what we are discussing it right now. Students, I have missed one point in part number 2. I just now recollected it. This point I have missed it. In article number 4 that we are discussing, the definition of resident of contracting state, I just now told you that you need to be a resident to invoke the treaty in both the countries. You need to be a resident in both the countries to invoke the treaties, isn't it? Question is that what if you are a resident in both the country? There is a possibility that you can be considered to be a resident in both the country. Like for example, in India, based on the number of days of stay, you can be considered to be a resident of India. And at the same time, in US, you are also a resident because you are a green card holder. So therefore, they are considering you a citizen of US. So because you are a citizen of US, under their tax law, you are a resident. Whereas in India, based on the stay in India, you can be considered to be a resident. So therefore, now there is a case scenario where a person can be considered as a resident of both the country. If he is considered as a resident of both the country, then the world income is going to be taxed in both the country. That is impossible. And to apply the treaty, one of the country has to be considered as a country of resident and the other country has to be considered as a country of source. If you have to apply the treaty, then one of the country has to be considered as a country of resident and the other country has to be considered as a country of source. So how do we resolve this issue? I think this point every one of you are aware that individually we will see that this is known as a tie break. When you become a resident of both the country, such situation is also referred to be a tie break. Now, when this tie break happens for an individual, then article number 4 provides that we will resolve the tie break situation in this particular way so as to determine that for which country you can effectively be considered as a resident and therefore the other country will become the source country. So this is the tie break rule that they have specified in the article number 4 so far as the individual is concerned. Now what is the tie break rule? I think we have discussed this point also in our discussion when we are doing the DTAA. So the discussion is based on permanent home. Check in which country out of the two you have got a permanent home. That country will be considered to be the country of resident. But if you say that no sir, I have got permanent home in both the countries, then you go to the next step. Now this step has to be followed in sequence. The next step, students, is the check in which country you have got the center of vital interest. When you say about vital interest means economic as well as personal. That is, economically in which country you are more well off and where your personal stakes are there, means your family and all. So that country will then be considered to be a country of resident and the other country will be the country of source. Generally, students, 90% of the cases gets resolved by point number 2, if not point number 1. So by coming up to point number 2, the 90% of the cases will get resolved over here itself. That is the center of vital interest. But if you say that no sir, in both the countries the stakes are equal, if you say that, students, in both the country the stakes are equal, economically I'm well off in both the country, I've got half family here, half family there. So therefore in that case, you cannot resolve the situation from here. Then you go to the third one. Third one says, fine, where you habitually reside between the two countries, where you habitually reside between the two countries, that country will then be considered to be the country of resident. Now again you bring the problem. You say, no sir, 50% of the time I stay here, 50% of the time I stay there. So habitually I don't know. Fine. Then they say, okay, then which is the country in which you are a national? Meaning thereby which country you do your voting and all. That country will then be considered to be the resident. Again you create a problem. So I have got a dual citizenship. I am a dual citizen in both the countries. What can be done? So they say that thank you very much. Then we cannot answer this question. Better do one thing. You just try to invoke the map. And what is that map? Map would mean that you kindly tell to US IRS and the Indian CBDT. Kindly make an application to them and please take your case with them and let they decide now for which country you can be considered as a country of resident so that the other country can be considered as a country of source. In US, like the way we have got in India CBDT, in US we have got IRS, the Inland Revenue Services. That is what we have it in US. So you make an application to these particular person and please, we have got other work also. Your case is not the only case. You let them handle your case and we can proceed further. So this is precisely how, students, you need to get into this. Yes, Sari. So indeed that's the point. So this is precisely the point, students, you have to really dealt with this. Please ensure to go to sequentially. Yeah? This has to be following sequence. The sequence is to be followed. The sequence is sacrosanct, isn't it? So that has to be followed, students. Now what if, students, if there's a tie break that will happen in the case of a company? Like you say, sir, how come a tie break can happen with a company? Why not? There's a company which is incorporated in France. There is a company which is incorporated in France. So because it is incorporated in France, the France domestic tax law says that it is a resident of France. The France domestic tax law says that it is a case of a resident of France. That is what the France domestic tax law says. At the same time, the Indian domestic tax law says that if the poem of that foreign company is in India, then it can also be considered to be resident of India. So again, in that particular case, double taxation will arise for this particular company. How do we resolve that? So here Article 4 says that, look, this is a very sensitive case. And it is better to, we cannot give a blanket principle or the test to be applied the way we have given for the individual. Let it be decided on the case-to-case basis. And if it is to be approached case-to-case basis, who will decide? So they say that better do one thing, invoke map. For the company, it's better to invoke map. Map would mean that apply to the France CBDT and the Indian CBDT. Let these authority will decide for which country, looking into the case scenario, for which country it could be considered to be the country of resident, so that the other country could be considered to be the country of source. This is the tie break rule given for the company. So this is what it is, friends. Now we have done with part 1 and part 2 completely. Come to the last part, which is the miscellaneous part. So the third part, students, is the miscellaneous part. Now, friends, you all are aware that what happens. Just now we were looking everywhere, students, that in above case, when we are discussing the allocation of the taxation right, in all the above case, whether it is OECD model or whether it is a UN model, at least one thing which was common, that they were not denying, while giving the right to the source country, in various articles that we have seen, they were effectively not denying the country of resident to tax that income. They were not effectively denying the country of resident to tax that income. So while giving the right, like for example, for business profit, if they have got the PE, then the source country can tax it. But they were not denying that the resident country will not tax it. As at least on the model, they don't deny this. Let it be denied in the actual treaty. Let it be denied in the actual treaty, but at least on the model, they are not denying it. So, the right of the resident country primarily is always there for taxation of those income which they have given it to the source country to tax it on the basis of, say, business profit, on the basis of, say, PE. For the interest and the FTS, which other income that we have discussed, even in those incomes, the source country, while it was taxing those particular income, there was no denial of the right of the resident country to tax it. In fact, they started off by saying that these income will be taxed in the country of resident. However, the country of source may also tax this income, but at a rate which is not exceeding a particular rate percentage. But at a rate which is not exceeding a particular rate percentage. That is what they are giving it to you. Isn't it, students? That is what they are giving it to you, students. So, students, in this context, if you say that the resident country is taxing this amount, source country is also taxing this amount, then one start wondering, sir, resident country taxes this income, source country is also taxing this income. Then in that case, it's double taxation. How do we resolve this then? So they have told you that fine, let the resident country grants the relief to its resident of the double taxation which is arising based on two methods. So therefore the resident country will grant what, students? Will grant the relief to its resident based on one of the two methods. And the one of the two methods are, first one is the exemption method. Now what is this exemption method? As per the exemption method, that income which is taxed in the source country will not form part of the total income, in computing the total income of the person in the resident country. So that is the exemption method. Exemption method is very simple, that fine, while I am computing my total income in that country in which I am resident, that particular income which I have earned in the source country, for which the treaty grants the right to tax in the source country, that particular income will not form part of my total income in that computation process. That is an exemption method. Whereas the second method that they are talking about it is a tax credit method. So the model, UN model and OECD model provides you two methods, that you can either go with the exemption method to grant the relief against the double taxation, or you can go with the credit method. India never follows the exemption method. We always follow the credit method. And we all are aware. We have seen that thing, discussion, foreign tax credit and all this thing. And as per the credit method, what happens? If India is a country of resident for a person, if that person has got any foreign income which as per the treaty is being taxed in the foreign country, then that foreign income will first be included in the total income. The tax liability would also be calculated on the total income as a whole, and thereafter from the tax liability, the foreign tax credit will be granted. Now I need not tell you how the foreign tax credit has to be granted. For that, we have already done section 90 and section 91 in detail in our earlier particular lecture. Perfect, Sunny. And that's exactly what it is. Now, there is one particular variant I should also tell to all of you students. Please pay attention to this last one. In exemption method, students, sometimes we find a very unique thing. What is this exemption method? Exemption method will say that this foreign income will be taxed in the foreign country only, and as far as the resident country is concerned, because exemption method is what has been followed, therefore this particular foreign income will not form part of the total income in the country of resident. However, this foreign income, although it will not form part of the total income in the country of resident, but it can be taken for rate purpose. If this is how the treaties are entered, that you have to follow the exemption method so far as this particular income is concerned, So this income will not form part of your total income in the country of resident. But that foreign income can be considered for rate purpose. So then what you will do? In that scenario, the steps that will be involved would be, you will compute your total income without considering the foreign income. Without considering the foreign income, and in the working note, you will try to determine what is the effective rate of tax which would be applied on that domestic income. So while calculating the effective rate of tax, you will take into account even the foreign income, and then you will calculate the tax liability, and finally you will calculate the average rate of tax, and that average rate of tax you will apply it on the domestic income. So the exemption method has got one variant, and that variant is that sometimes they say that although it may not form part of the total income in the country of resident, but it may be taken for rate purpose. And if it is to be taken for rate purpose, this is what, students, it has to be done. I hope that every one of you are clear with this one. With that, there are last 2 points when this topic is over. One is the map. Now here, the mutual agreement procedure. What exactly it is, just pay attention to it. Map. Just now we have got an opportunity while we are discussing the tie break and all. At that point of time, we discussed what this map is all about. Students, generally the map, apart from that residence test, what we discussed about, we have discussed that residence test in which the map is to be invoked for individual, the last resort, for the company, the first resort and the only resort. For the individual, it was the last resort. For the company, it was the first and the only resort, that you invoke the map and let the authority decide for that foreign company in which country it could be considered to be a resident. So that was for determining the resident, that we are invoking the map. But apart from that, what else? And what is the major ground? Students, this is what is the scenario. Students, here what happens is that, consider an example. I am a US resident and I have got an income earned in India. So my source country is in India, my resident country is in US. Now, the way the Indian tax authority are treating my income for tax purpose, I think this treatment is not in accordance with the treaty. That is my particular proposition, that the way the Indian tax authorities are treating my income, I strongly feel that this is not in accordance with what, students? With the treaty provision. And I have got now the objection. Now, since I have got the objection in this particular case, now what I'm going to do, students? What am I going to do? Are you aware of that? I am now going to invoke, students. Please tell me. I am now going to invoke the map. Now, how this map will get invoked, I'll tell you. The approach in OECD and the approach in UN model. By the way, students, tomorrow, are you aware of that? Tomorrow our session timing. Are you aware of our session timing? 11:30. 11:30 is our session time, students. And tomorrow I am going to do with you the trust taxation revision. Are you ready for that, students? Are you ready for that? So the trust taxation revision will be done tomorrow. Obviously, we will not be in a position to complete it, but definitely a substantial portion will be in a position to discuss it tomorrow. And then next Saturday, trust will be over and the next TDS TCS will get started. Are you excited, students, on the revision part? Only your excitement will decide the further course of action. So how this particular map, students, gets invoked based on the OECD and based on the UN model. Sunny, Ujjwal, Amrita. Based on the OECD model and based on the UN model. Mamta. So in this context, students, the OECD model the OECD model, what it says this, that just now there are only 2 questions that can be asked. Please pay attention, students. Only 2 questions can be asked, students. The 2 questions are, number 1. First question is this, that the OECD model says that the taxpayer can make an application. So I am a US person, resident of US. I can make an application either to the US tax authority, or I can make an application either to the Indian tax authority, as the case may be. As the case may be. So I can make an application to the US tax authority, or I can make an application to the Indian tax authority, as the case may be. Okay, this is very unique, because your model does not say that. Your model says that who you are a US resident, so please come to the map through US. Means you will make an application of map to your US IRS, and let the US IRS approach to the CBDT that there is a problem which is going on in your country. Your income tax authority are taking a position which is not in accordance with the treaty. So your model is bit conservative. Your model, students, is bit conservative here. Your model says that no, you are a resident of which country? You are a resident of US? You'll say yes, I am a resident of US. So do one thing. If you are a resident of US, please approach to US IRS, and let IRS will make a cross application to the Indian CBDT, and they will decide. So it seems to be a bit conservative approach, or maybe a long drawn approach. But OECD model convention is very, you can say, dynamic. It says what? Okay, you have a problem. Catch the bull by its horn. Catch the bull by its horn. Problem with whom? Indian tax authority? Yes. Do one thing. Make an application. Make an application to the CBDT. Make an application to the CBDT. That exactly is the point, students. So therefore you are finding this, that you can make an application directly to the CBDT in this case. This is exactly the point, students. I hope that every one of you are clear. So this is the flexibility which the OECD model convention gives, which is not there in the UN model. So this is for the map. So this is the first distinction point that you should always keep in mind. Now the second one is about the arbitration. This is the second point that they can target. You can say, sir, what is arbitration? That is also a good question. So students, arbitration will mean this. Be careful, students, now. Arbitration, students, will mean this. That, okay, map I've invoked. Both the taxation authority, I don't know, they're busy for how many days, for how many months, and nothing is coming out. I don't know what they're doing. Even they don't know what they're doing. And they are not in a position to arrive at a common conclusion. Because at the end of the day, it's like a bargaining, tug of war. Who will yield? That's the challenge. Because everyone wants to protect the interests of their country. So who will yield to this? That's the challenge. And therefore, many a time there's a deadlock. Although the map is being invoked, but neither you want to take back your position, nor you want to take back your position. So therefore, in that case, there is a deadlock. And this kind of a deadlock is resolved through the arbitration process. And what is the arbitration process? We'll say that there is a judge who can be appointed, and let you both, you are known, the CBDT. So in the CBDT and the IRS, in my example which I'm using, are known as CAs. CAs means what? Chartered accountant? Not chartered accountant. They are known as competent authorities. So there are competent authorities. Competent authority of CS. Competent authority of CS. Who is CS? Company secretary. CAs of CS. Chartered accountant of company secretary. Isn't it? After doing so many studies and all, on the day of the examination, the bigger risk is this actually. What I fear a lot is this. At the end of the day, you are so near to ATU deduction that you yourself don't know what you need to write. So near to that ATU. And therefore, the CAs, the chartered accountants of the company secretaries, will then go for the map. And this is the kind of the answer, students, that you're going to put up. So therefore, you have to be very careful. The CAs in this case is the competent authorities of the contracting state, not the chartered accountants of the company secretary. A new phrase that you are revolving. So therefore, in that particular context, it is the competent authorities of the contracting state. Which contracting authority, students? The contracting authorities are the CBDT and the IRS. Did you all got this one? All of you students. So arbitration, students, is this. This is what the arbitration is all about. That is to say that you are then trying to say that now it is enough. I am also getting a headache. let's get into the arbitration process. Now, OECD Model Convention says this, students. Please be confirmed. This is second distinction. The first distinction I told you, that OECD can take you are a US person, but you can make a map application directly to the Indian CBDT. Whereas in the case of UN, no, you have to apply the map only to that country in which you are a resident. So let your country tax authority approach to the other country's tax authority. That is the approach which the UN model says. The second and the most important distinction in the map is that the arbitration process can be initiated by whom? By me. I am the one who can initiate the arbitration process. Because as I told you, I am getting frustrated. And therefore, I am the one who can initiate the arbitration process. Whereas in the case of UN Model Convention, if you see, the arbitration process, students, can you see that? Must be requested by the competent authority. They are getting frustrated. In the UN model, they should get frustrated. And therefore, they are not in a position to resolve it. So they decide finally, let us do one thing. Because we cannot arrive at the negotiation, let's get into the arbitration. And therefore, they decide the arbitration and they will notify to me. They will notify to me that, look, we both have brainstormed to this issue, but we cannot come to a common consensus. So therefore, we are deciding for arbitration. So this is what is the fundamental difference in the map under the OECD versus the Model Convention. Is that clear to all of you, students? You just be focused on the relevant points which I'm discussing with all of you, and that is all, nothing more, nothing less. And the last now, students, the overview of the Model Convention is the exchange of the information. This is your last point. That's it. It all will get through. Exchange of information, students, is such a critical stage. In fact, I consider going forward, this is a game changer. Because now we don't hear anything about Swiss bank and all. Earlier, there was a time about Swiss bank, everything, the hidden money stashed in the other particular country. Now is the time of being a beneficial owner, being a beneficiary. These are the times today. Earlier, it was a time of my income being stashed, my own income being stashed in the Swiss bank and all. This was a time earlier. Because I knew that that country government will not share the information. That country will not share the information to my government. And therefore, I was so bold enough in those earlier times that in my own name, I used to keep those assets. In my own name, I used to open a bank account. Those were the golden times, isn't it? Now today is the time of the beneficial owner and the beneficiary. I will not be holding anything in my name. I will hold in someone else's name. That is the time that we are having today. So therefore, no surprise that we have got the Panama Case. Are you aware of the Panama Case, students? Popular, particular, personal, influential person name are getting leaked in the Panama cases and all. Isn't it? What exactly it is? This is the same thing, beneficial ownership or the beneficiaries. Anyway, that how this transformation has happened? How the transformation has happened? The transformation, students, that I'm talking about, it has happened because of this, the tax exchange information agreement. Now, your asset, your bank account in the foreign country, the government will tell to your government. This is a game changer. And see how now the new ways of beneficial owner and the beneficiary has came in existence. Did you all got this one? And if you have got hold with this one, students, do like this video also. This is how we have changed this entire time now. So accordingly, students, in this particular case, the situation is like this. If a particular person, students, is having their asset, their bank account in the foreign country, then automatically that foreign country will be exchanging the information to our particular government. And it is a vice versa process. Even our government automatically have to share the information to the government whose resident are having some financial interest in our country. It's a vice versa process. And therefore, people today time fear to have your asset, your bank account in the foreign country unless it is earned out of the tax paid income. Now, what would be the examination question as far as the tax exchange information is concerned? The examination question is this. The examination question, students, is this. OECD and the UN Model Convention. What is the examination question, students? Please pay attention to this one. Students, these are the confidential information. And the other country will not share this information with you unless they have got the confidence that you will not share this information in the public domain. Because these are the confidential information. Remember, students, I remember those parliamentary discussion. I was hearing to the late Finance Minister Arun Jaitley in the floor of the parliament. Now the government knows it. Who are the person who has got the black money in the Swiss bank? They know each and every detail about it. And there was like a political hue and cry. What was political hue and cry that was being made? That why don't you tell the names of those person? Now, see, this is what it is. Like common man or the average man don't know about these international protocols. You cannot say the name. That is what it is. Because they have given this information with the bona fide intention that you will not be sharing this information to anyone. And therefore, now the pressure was being built up, of course, in this case, that please disclose the name. You are protecting some particular big people and all, who your accomplice and all those stuff. All these things are there. But please understand, no government primarily can disclose the information in the public domain. This is what we are reading right now. So if you got the information, you're privy to that information, but you cannot disclose this information to anyone. Because the information was being shared with this particular bona fide trust. Secondly, students, any information which is relating to the conversation or any kind of the communication that has happened between the lawyers and the client abroad, like Vijay Mallya's lawyer, and obviously Vijay Mallya would tell the truth at least to his lawyer. He will tell the truth at least to his lawyer, and accordingly the lawyer will prepare the case to defend him in this particular court. So can India ask, no, I want to know what is that conversation, because that is what is the ultimate truth. If supposingly tomorrow, if this happens, then even tomorrow to tell to my lawyer my truth, I will not be in a position to do that. Isn't it? So this is something, any conversation between the attorney and the client, that communication will not be shared. That is very clear. If it is prohibited in the domestic law. If it is prohibited in the domestic law. Is that clear to all of you, students? And the third one, students, is this, that in this context, that the foreign country which is supposed to share this particular information, the foreign country, students, which is going to share this particular information cannot ask this question that why you want this information? For what purpose you want this information? First tell me the purpose. What you're going to do out of it. I need to know that. This cannot be your particular questioning. You need to just give it primarily. You cannot question for what purpose that you're going to use this information. This is what you need to remember, these 3 points. For exchange of information, students, just remember these 3 points. That one cannot be shared primarily to the public domain. Second is that conversation between the attorney and the client also cannot be exchanged, that conversation, if it is prohibited in the domestic law. And the third one, students, as you can see, is that the country which has to share the information cannot ask or cannot withhold the information till it knows for what purpose it is going to be used. So this is what it is. Now the next one is BEPS, students. I'm going to wrap it up very fast. It's a very simple thing. Now come to this one. BEPS action plan will get wrapped up very soon. Now you'll say, sir, how much time it will take? Students, maximum half an hour. We'll be done. Don't worry. Maximum half an hour. We're done with this particular thing. Any doubt, students, in this case? Now I have told you, resolve this. Now this is what it is. Your 80% of worry is over. Now only 20% of worry is left. Congratulations, students. Your 80% of worry of your theory on international taxation is over. Now only 20% of worry is left. So I am now going to quickly wrap up this 20% also for all of you, so that everything is done and dusted. So OECD and UN model convention split into three parts. Which are the three parts? First part is that definition and the applicability. Second part, the allocation right for all the incomes, business profit, thereafter the interest, FTS, royalty, capital gains, and independent personal service. Close your eyes, recall. Close your eyes, recall. If you can recall the distinction and all, that's it. Don't have to revise it. And the third one is what, students? Is the case of MAP, the exemption method and tax credit method. And the last one is what? The case of the exchange of information. This is your third part, and that is how you trash out this particular theory. In fact, if I were you, I will ensure to do a smart revision so that on my day of the examination, I'm preparing it for the day of the examination, this entire theory should take not more than 15 minutes to revise. And I've given you the smart strategy as to how you're going to go about it. Now, this is a very popular 1 or 2 marks question, students. I will tell you the golden rule of interpretation, students. The golden rule always is that the word should be interpreted or its ordinary meaning or a literal meaning. You should do the interpretation of a word as per its ordinary or its literal meaning. That's a golden rule, or the objective interpretations are all about. Word should be interpreted as per its ordinary or the literal meaning. Now, what do you mean by this ordinary literal meaning? I'll just give a very simple example. Students, a simple example. The example is like this. The example, students, is like this. Please pay attention, students. The example. The example in this regard is in the transfer pricing, you are told that, please pay attention to this one. In the transfer pricing, you are being told that the associated enterprise has earned 60% of gross profit margin on the transaction which it has entered with the non-resident associated enterprise. How much margin? They have earned 60% of the gross profit margin in the transaction that it has entered with whom? Entered with the non-resident A. Question therefore to all of you is this, that if they have told you that this is a case of a transaction wherein the Indian associated enterprise has sold the goods to the non-resident associated enterprise, and in that particular transaction they have earned a 60% of the gross profit margin. Question therefore to all of you is this, that this 60% of the gross profit margin will be considered as what? Shall it be considered as a margin on sales or a margin on cost? What should I consider this as? Now, this is what the interpretation is all about. What should I interpret this margin as? They are saying that 60% is a gross profit margin earned in this particular transaction. So this gross profit margin which I have earned, should it be considered as a margin on profit, or should it be considered as a margin on sales, or should it be considered as a margin on cost? Which would be the correct interpretation? Amruta, Sunny. And that is the ordinary meaning. That is the ordinary meaning. The ordinary meaning is what? It is ordinary meaning or literal meaning is that margin is always vis-a-vis the sales. This is how the ordinary it has to be understood. Isn't it? So that exactly is the point. And this is what it is, students. Now the subjective interpretation, students. What is subjective interpretation? The common intention of the parties while entering into the transaction. This is what was the common intention of the parties while entering into the transaction. That is what also could be considered. That is what also can be considered. Now please be very careful over here. When you talk about the common intention of the parties, what does it imply? It will imply, students, this. Be careful now, all of you. It will imply this. Like for example, you remember in this case, how do I know how do I derive the common intention? Generally through the speeches. Generally through the speech, I understand what is their intention. Like for example, you know, when the government, when the prime minister or any of the government, they go to the other country. So they go along with their ministers, and you see a lot of like documents are being exchanged and handshakes are there, and then the speeches are being made, isn't it? That speech is very critical, because that speech tells you what is the intention for entering into these kind of an agreements. So that is what can be considered for the purpose of the interpretation of the treaties. So this is known as a subjective interpretation, which is going by the intention of the two parties to this particular treaty. What was the intention behind that? For that purpose, we can refer to their speeches so as to know the intention. The theological or the purposive interpretation. Now this is through the preamble. Students, this you will come to know. The aim and the objective of any law or a treaty you will come to know through the preamble. So this you will come to know through the preamble. The theological or the purposive interpretation, students, through the preamble. See the preamble of the law, you will come to know what is the aim and the object of the law. Like for example, FEMA. So check the preamble of the FEMA, you will come to know what is the aim and the object of this particular law. Is that clear to all of you, students? Thereafter, students, principle of contemporanea expositio. Can you see that, students? Principle of contemporanea expositio. This is the last one over here. Now, as per the principle of contemporanea expositio, what it says is that the word which was understood at the time when the treaty was concluded, the word as it was understood at the time when the treaty was concluded, that should be the meaning that should be accorded or should be considered while doing the interpretation of the treaty. So what was this word that was being understood at the time when the treaty was entered? That is the meaning that should be given at the time of interpretation of the treaty. This is what is the principle of contemporanea expositio, or may I say the static approach. This is also a very static approach. Static means still. This is distinguished with the ambulatory approach. Ambulance approach, not ambulance approach, ambulatory approach. What is this ambulatory approach? Ambulatory approach, students, is that at the time of application of the treaty, at the time of the application of the treaty, what is the meaning of that particular term? So obviously, as the time will change, students, so will be the meaning. So therefore, as per the ambulatory approach, it says that the meaning of the word at the time of the application of the treaty should be considered while doing the interpretation. The meaning at the time of application. This is the ambulatory approach. And what about the contemporanea expositio or the static approach? What it says? It says the meaning at the time of conclusion of the treaty. So you can write, students, meaning at the time of conclusion of the treaty versus meaning at the time of the application of the treaty. So meaning at the time of the conclusion of the treaty is the contemporanea expositio or static approach, and the meaning at the time of the application of the treaty, that is known as the ambulatory approach. Is that clear to all of you, students? These are the topics which are common topics. These are theory topics in the CR module. In that case, you will find it. Now, this is principle enunciated in the Vienna Law of Convention. Can you see this? This is the mother of all laws. Vienna Convention 1929. Now, so far whatever we were discussing, generally our discussion was, students, about the interpretation and the principles of the Double Taxation Avoidance Agreement Treaty. Now, the DTAA is a tax treaty. But do you think that internationally, the two government only enters into the tax treaty? Internationally, the two governments are entering only to the tax treaty? Or there are other treaties also? Many treaties are there. Many treaties are entered by the government of each country, And these are different treaties: water treaty, tourism treaty, defense treaty, this treaty, that treaty, and treaty after treaty. So what should be the principle of all the treaties which the government of the two countries enters into it? That principle, students, is given by the Vienna Convention of the Law of Treaties. The Vienna Convention of the Law of Treaties. So that is the Bible. Of all the treaty, this should be the principle that should be there of all the treaties, including therefore the tax treaty. So tax treaty is one of the treaty, whereas you have got other treaties also which is being entered. So what is the core principle? The first core principle, students, the first core principle of the Vienna Convention of the Law of Treaties is, repeat with me, the first principle is the Pacta Sunt Servanda. What it is? The Pacta Sunt Servanda. This is the game changer, students. If you are going for any interview of the international firm, then in that case, the first and the foremost they will attack. Do you know what do you mean by the Pacta Sunt Servanda? That is to say that every treaty that you enter will be binding on both the parties, and it should be implemented in good faith. It should be implemented in good faith, students. This is the core principle. That you should endeavor from yourselves within that you are going to implement this treaty in good faith. Because obviously people will try to arm twist, isn't it? Many people will try to arm twist, and they will try to extract more, give less, extract more, give less. So in fact they will try to like for example, they know that here the treaty is not properly worded, so let me exploit this particular treaty to my advantage because of the proper wordings, because of the lack of proper wordings. So therefore let me try to exploit it to my advantage. Are you, students, doing this now in good faith? No, you are now arm twisting. Don't do this arm twisting, because students, it reduces your credibility. And therefore what happens? Tomorrow the other particular foreign government knows that although you enter with the agreement, but you are known for arm twisting. This is what China has done. Why many countries are skeptical to China? Because they enter into a treaty but they don't implement in good faith. That is what the Chinese treaties are all about, and we therefore are very some sort of a discomfort. Unless we don't have any other option internationally, then only we shake hands with China. And that is what we have seen, the fall of many countries internationally because of the treaty that they enter with China. So they in fact don't go with this principle of Pacta Sunt Servanda. China have got their own treaties, their own principles, doesn't it? Which is above every principle. I think even to that extent, US can be considered to be not doing proper justice of good faith. Anyway, that is something which is not up for discussion, but nevertheless. Non-retroactivity of treaty, students, all of you are aware. No, Sunny, it is SUNT. Non-retroactivity, students, if the treaties are entered into 1990, will it be considered to be retrospective from 1947? Answer is no. Treaty should always be prospective unless it is made retrospective. Treaty, students, will be always be prospective. Any treaty, not only the tax treaty. Now when it comes to Vienna Convention, please don't use the word taxation, double taxation avoidance agreement, because Vienna Convention is applicable for all the treaties. So any treaty which is entered will be having a prospective effect, not a retrospective effect, unless it is specifically provided for. Territorial scope, obviously the territory in which it will be applicable. Generally it will cover the entire particular territory of that particular country where the application would be felt, unless the two parties are carving out any of the treaty, any of the territory in which the treaty will not apply. Like for us, like we have got J&K, where as per our constitution itself, we have to check at the parliamentary legislation whether it could be applied in the J&K or not. So therefore the treaty otherwise will have the application absolutely to the territory of the respective country, unless they have carved out any of a particular territory in this case. So in this context, students, this is what it is. Now the next one, students. In this regard, general rule. Which is general rule? Golden interpretation. General rule, students. Ordinary meaning. The golden interpretation is what? Go for the objective interpretation, ordinary meaning. And what is the second one? Is the intention, the subjective interpretation. So to interpret any treaty, Vienna Convention says, go as per the two rules. Which is the two rules? The first two. The general rule, which is the objective, the golden rule, which is the objective interpretation. Take the ordinary meaning of the term. And what is the second one? The subjective interpretation, which is go with the intention of the parties who wants to enter into the treaty. So that is a golden rule that they have mentioned. Supplementary means. Now sometimes supplementary means also can be considered for the purpose of interpreting any treaties which the two countries have entered into. What is this supplementary mean, students? Please understand this. See, before entering into a treaty, you all know the secretary of the two countries, like foreign secretary in India, the foreign secretary of that country. These people do a lot of round of talks. Like for example, important this Rafale agreement that took place, the defense agreement. That ultimately the Prime Minister or the Defense Minister would have gone and he has signed this. But do you think that that was the only thing? Before, when they entered into that treaty or the agreement and all those stuff, in fact, there was a lot of paperwork that would have been involved, both from the Indian secretaries or the foreign secretary, ambassadors and all, defense secretary and their particular people. So they would have covered a lot of background material and finally they would have given the final shape to the agreement. So if some of the terms are ambiguous, they are not clear or they are obscure. So if we have to understand those terms properly so that our interpretation are not unreasonable, can we refer to this particular supplementary or the preparatory work which was being made before the treaty or the agreement was entered between the two countries? To that the answer is yes. That if the interpretation of the word is resulting into an ambiguous result or it is giving an unreasonable interpretation, then definitely you can refer to those preparatory work or the supplementary work for the purpose of the interpretation of the word. Rest of it, students. Now the last one, students, 60, 61 and 62. 60, 61, 62. This is the last one, which is an important one. Termination or suspension of operation of treaty, students. Termination or suspension of operation of termination or suspension of operation of treaty as a consequence of breach. Students, if there is a material breach of a bilateral treaty by one parties, material breach of bilateral treaty by one parties, then in that case, whether this can be the ground for the other party to terminate the treaty, and the answer is yes. And the answer is yes. So this is the material breach. So obviously now the best example, students, is the Russia and Ukraine conflict. Do you think that all the treaties and all will be honored henceforth? The treaty which is entered between Russia and Ukraine, will it be honored in this case? Answer is definite no. There is a material breach that has taken place. So that will result into what? Result into termination of suspension or the operation of treaty as a consequence of this one. Say there is a peace treaty between the two countries. Which treaty? Peace treaty. Very nice name, isn't it? Peace treaty between Russia and Ukraine. Now, because of this kind of a conflict, do you think that the peace treaty will be survived? Whether the peace treaty will be survived, and the answer is no. This cannot be survived because there is a termination or suspension of operationality as a consequence of breach. The peace itself has gone for a toss. So that is the point. Thereafter, the another angle is supervening the impossibility of the performance. Now, because of this thing, students, you tell me one thing. There is a peace treaty, but because of the peace treaty, there are other particular impact which is also happening. Say, for example, there is for example, I am talking about it, students. There is some natural resources of Ukraine that was being, as per some of the treaty, that was supposed to be given to Russia, as per some treaty. Do you think now it will survive at this point of time? Now it is impossible for Ukraine or for Russia, for example, in this case, to implement that treaty. So whether this impossibility of performance, can that be invoked as a ground for terminating or withdrawing from or suspending the operative treaty? And the answer is yes. if there's a destruction of an object in this context. Say, for example, you would say that many of the bombs would have put up by Russia herein in that particular mines, resulting into destruction of the object which is indispensable for the execution of treaty. Resulting into what? The destruction of that particular object, resulting into which is indispensable for execution of treaty. So now, can we supply these uraniums and all? And the answer is no. So can that be the ground that can be there? Can it be considered as a ground to suspend, or may I say ground to primarily say that let the treaty be suspended? And the answer is yes, because there is a permanent disappearance or destruction of an object which was indispensable for the execution of treaty, and therefore such kind of a treaty also will die now. Such treaty also will die now because there is an impossibility of performance. Why Ukraine and Russia? Say, for example, Ukraine and India. There is a treaty wherein India was looking for getting the uranium. Now, between Ukraine and India, India has become a sandwich. And as it was being said earlier on the other day, that we have got the interest with both the countries. And now what is happening? Ukraine was supposed to give us the uranium. Russia has bombed those particular cases. Uranium is gone. That plant got destroyed. India is waiting for the next dispatch of uranium. Do you think Ukraine will be in a position to dispatch this particular uranium now to India? There is a permanent disappearance, or there is a destruction of the object completely, primarily. So therefore, there is an impossibility of performance. Although then there is a treaty between Ukraine and India, but since there is an impossibility of the performance, therefore in that particular case, the treaty can be terminated or withdrawn. In this case, between whom? Between India and Ukraine. That treaty is gone now. That treaty is gone now. So now you can see the stakes which are involved, how much big the larger has a stake with this kind of a conflict. Now, one thing that they are saying is that, however, the party who is a defaulter in this case, they will never have the ground. Who is the one who is a defaulter? In this case, the one who is being portrayed as a defaulter is Russia. So that country will never have the ground of terminating the treaty because of the impossibility of the performance. Because you are the one who are the party who is considered to be the defaulter. Who is the party who is considered to have made the breach. And that exactly is the point. And the last one is about the fundamental change of the circumstances. So this is about not about any breach that has taken place. This is about what, students? The change of circumstances. Now, for example, the classic example is COVID. Now, many tourism agreements was being there. Many treaty, which is like, for example, tourism was there between many countries. Now, do you think that can survive? In this COVID, anyone who entered the treaty at that time, primarily who entered into that time, this was not foreseen by the parties. The COVID was never foreseen by the parties. Any parties have not foreseen it, and they have entered into the tourism treaty. Now, during that particular point of time, students, now you can just imagine there is a change in the circumstances which has occurred in the future, which was not foreseen by the parties who have entered into the treaty at that point of time. So they have not foreseen this particular thing. Now this has occurred. So can that be the ground of terminating and withdrawing? And the answer is yes. If what? If this constituted an essential basis of the consent. See, the tourism treaty can be terminated. But what about a treaty like? Students, what about a treaty like defense agreements? Can COVID be the basis of terminating the defense agreements between the various countries? And the answer is no. COVID is not the basis. You cannot say this is the essential basis of giving the consent, that the COVID should not have been there for the purpose of a defense agreement. So therefore what they are trying to say is that if there is a change in the circumstances which was not been foreseen by the parties, then that change in the circumstances can be considered as a basis of terminating that particular as a basis of terminating that particular treaty if it was an essential basis of entering into the treaty. So therefore, in that case, therefore I gave the example of tourism treaties. So tourism treaties, will that be gone? Answer is yes. But what about the COVID? Answer is, what about the defense treaty? Because of the COVID, will that also evaporate? Will that also get terminated? Answer is no. With this, students, your second leg of theory is over. Now, this leg of theory is as good as done, the BEPS. Students, you all are aware about the BEPS action plan. I think all of you are aware of this BEPS action plan, the last one now. This is the third and the last one. This is the simplest one. So, because we have already considered earlier also. Students, like for example, come to the first one, the BEPS action plan. What is this BEPS action plan? Because of the multinational company adopting the aggressive tax avoidance strategy, which was in respect of the cross-border transaction, because of the multinational companies was aggressively devising lot of tax avoidance strategy in a cross-border transaction, that has resulted into a huge amount of loss to the tax revenue of across all the countries. It is not only about one particular country. Across all the countries have suffered from this aggressive tax avoidance strategies which were being entered by the multinational companies in all their cross-border transactions. So therefore, the G20 was being formulated, the government of 20 countries, the powerful 20 countries, in which India was one of the most important country. So in the G20 country, they appointed OECD to come up with what are the issues which are there and which is plaguing this problem of our tax revenue because of the aggressive tax avoidance strategy. So please identify what is that aggressive tax avoidance strategy which the multinational company is adopting, which results into the loss of our tax revenues. Please identify that, point number one. And secondly, also give us a solution. How do we address this particular this kind of a nuisance? So the first one, as you students, all of you are aware, the first one and the foremost one is about the e-commerce transaction, the digital commerce activities. That is the first. The OECD in their action plan report. So this is known as the base erosion profit shifting action plan report given by the OECD. So the action plan report, the first thing that they gave was about the digital transaction or the e-commerce transaction, which results into a huge amount of loss of the tax revenue, for the main reason that we cannot identify clearly as to which is the country of source, in a digital transaction or an e-commerce transaction. So because there is an absence of a proper means to identify which will be the country in which there will be the e-commerce transaction will be considered. So therefore, which country will be considered to be the country of source in this e-commerce transaction? Therefore, this was the first particular action plan that they have given, that look, this is the problem, and the solution to do, or the way to tackle, is that not the income tax. They've given the two solutions. One solution they've given it in the income tax, and another solution they've given it outside the income tax. And outside the income tax, the solution that they've given is through the equalization levy. That you need to introduce a separate levy altogether, which is not in the nature of an income tax, so that, because if it is in the nature of income tax, then you are again grappling to decide which is the country of source and which is the country of resident, which is the fundamental pillar of an income tax law. And therefore, try to introduce a separate levy to this e-commerce transaction, and accordingly we, under our domestic law, has immediately have accepted that particular recommendation. And now we have got, there are two forms of equalization levy under 165 and another is 165A, whereas in 165 the equalization levy is deducted by the payer of that consideration. In the case of 165A of equalization levy, the TDS particular part, in 165A, the equalization levy has to be paid by the service provider. So that is the answer that we have got it up till now. Two equalization levy we have got it. The second one, yes Sunny, The second one is a significant economic presence. Now, this is what is SEP as a concept, which is also is SEP, which now is finding a place in our domestic tax law, is thanks to the recommendation given by the OECD under the BEPS project. So what is this SEP? Now, this SEP concept is introduced under the income tax law itself. Now, just for an example to open up our discussion, students, an example is that in that COVID 2 years, many physical shops got over. So, say for example, there was a UK firm or UK company. They were having a branch in India or departmental stores in India, and through the departmental stores in India, they were supplying their goods. But now, 2 years of COVID, they have shut down their particular branch in India permanently. Now they also know that they need not have any other branch in India, because now we are so popular that the customer can directly approach us to the website, and through our website we will directly sell that goods to them from UK itself. No need to have any physical presence in India now. So therefore, there would be an absence of physical presence in India. There would be an absence of permanent establishment in India. There would be an absence of business connection in India, and accordingly the buyers from India are still approaching us, but not physically, but they are approaching us directly through our website, and there from we are selling our all merchandise, all our goods to the Indian buyers. So without having a physical presence, we have got a significant economic presence. Without having a physical presence, we still have a significant economic presence. So what they have done is that they have told that it's time that we now consider a significant economic presence will also result into the permanent establishment exposure in India or a business connection in India, as the case may be. So therefore, now what we find, students, is that a significant economic presence in a source country will give rise to a PE exposure as per the treaty, and also will give rise to a business connection as per the Indian Income Tax Act. So it will give rise to both. So significant economic presence has been incorporated under the treaty also. So therefore now, even though you may not have any physical presence, but you may have a economic presence which is significant enough, that will also be considered as a exposure of PE of that person in that other country. And also under the domestic law, we have got this to be considered an SEP, a significant economic presence, is also considered as what? As having a business connection in India. Now, what do you mean by the significant economic presence? So, now this is very important that you should know. This I will say that it can be targeted in the examination. Like for example, consider a departmental store example. They don't have any physical presence. They don't have the branch. Directly the buyers from India, customers from India, they are approaching to the website, placing their order, making the payment to the website, and the UK departmental store directly dispatches the goods from UK to the Indian customer. So what they are saying here, in respect of goods, services, properties carried out by a non-resident with any person in India, including the provision of download of. So goods, properties are being sold to any person in India, Then the aggregate of the payment arising from such transaction or transactions during the previous year. So the Indian buyers are making the payment, and the aggregate of all the payments made to that particular non-resident, if it exceed rupees 2 crores, we will say that the non-resident is having a significant economic presence in India. What about the next point, students? The next point, if you see, which we have a systematic and continuous soliciting of business activities or continuous in interaction with the users in India. Now it is just like this. Say for example, a foreign company have devised an app, and everyone has downloaded the app. From India, the people they don't have any physical presence. They have got the app. From India, the total number of people who have downloaded that app is more than 3 lakhs. Is at least 3 lakhs. The total number of people who have downloaded the app is 3 lakhs. So if you have got a significant number of users, primarily, and now through the app, they are soliciting. See, understand one thing. They are soliciting what? The business activities. Or they are interacting with the users in India. Because now in the app they will give a lot of advertisements and all about the product, so that they will get knowledge about this one. So therefore, if you have got the number of users which is 3 lakhs or above, which is in India, so accordingly even this will give rise to a significant economic presence, resulting into this one. The next one, students, is the BEPS action plan number 3. Now students, what exactly it is? Even this is an important one, just pay attention to this one. But although it is not that much relevant, but still you should know what was the impact of this action plan 3, which was given by the OECD. This is a Controlled Financial Corporation, CFC. This rule, students, is about not India. India actually was not that, like what to say, India for this BEPS action plan number 3 was fine. Okay, fine, you have given it. This actual rule was majorly targeted to US. But India still has made this particular BEPS action plan number 3 as a part of their domestic law. How they have done it, we'll see. But the target was US here. We all know, students, US, majorly all the big companies that we all know are having the headquarters in US. Across the world, you will find the subsidiaries. Headquarter location is in US. Across the world, you have got the subsidiaries. That is what we are seeing. So in such a kind of a situation where US is a headquarter location and all the remaining countries are the subsidiary companies across the world, so therefore the US will be getting the dividend. Now, knowing the fact that the dividend in US is taxed at a very higher rate, so the US company, holding company, will tell this one, look, wait for it, don't declare a dividend to us. Till the time we tell you to declare, don't declare it. So they are influencing all the subsidiary company, the timing and the manner in which the dividend will be declared. And definitely, generally the trend was that in the year in which the US company has got a significant amount of loss, the holding company gets a significant amount of loss, that they tell to their subsidiary, now please give us the dividend. Why? Because now that dividend, we will be in a position to knock it off with our losses so as to save a substantial amount of tax liability. So this is what these people were doing it. So accordingly, what the OECD BEPS action plan number 3 they have suggested, as per their suggestion, they have told that, look, you do this particular thing. You introduce a concessional rate of dividend taxation, because right now you are taxing the dividend income that you are receiving from your foreign subsidiary at a higher rate, the normal rate, say 30 or 40%. This is the reason why they don't want to bring the dividend income in India, in your country. So, but if you slash the rate of dividends to say 15%, then suddenly you will find that now, since it is going to be taxed only 15%, let me get all the dividend in. So this is what is the action plan number 3, and this is what primarily US adopted. Even India adopted this, because India also have got some of the holding companies, although few, like Infosys, TCS, Reliance and all. So they can constitute the Indian holding company who are having their foreign subsidiaries, in which these companies, the Indian company have got what? Minimum 26% or above voting power in those companies. So accordingly, even there would be some sort of a reluctancy that the Indian holding company will show to receive the dividend. So therefore, even the Indian government, going by the BEPS action plan number 3, has primarily provided for a concessional tax regime for a dividend from a foreign company received by an Indian company who is holding at least 26% or above voting power in such foreign company. So the dividend which is received will be taxed at the rate of 15%. The concessional rate, students, would be the tax rate of 15%, 115 EBD. So this is a concessional rate of 15%. And that exactly is the point. So this is what your BEPS action plan number 3 is all about. Coming to the next one, students. We all know, students, this one about equalization. The thin capitalization, students. Again, another headache. The thin capitalization, students, another headache. And what is the thin capitalization? You are raising your debt from the non-resident AE, and you don't want to raise the equity, because you don't want to raise the equity, and you will never raise the equity now. For the reason is very clear that you know that by raising the debt from the non-resident AE, I don't have to repay it immediately, or I will repay it wherever we both decide. So there is no compulsion of repayment. and let me get the debt only from him and keep on paying the interest to him also, because at the end of the day the interest also goes to my associate enterprise and the things remains at home, it doesn't go outside. And what is the advantage for me? I get the deduction of the interest. Even if the interest is paid at arm's length price, even if I'm paying the interest at arm's length price, still I'm getting the deduction. So this becomes a huge headache, and therefore 94B, now BEPS, they have said that we need to get an upper cap. We need to have an upper cap of how much of the interest that could be allowed as deduction from the debt that has been raised from the non-resident AE. And they have given the recommendation. India also accepted immediately that recommendation, and we introduced 94B, which is about a thin capitalization, and the upper cap of the deduction of interest is 30% of EBITDA. EBITDA, interest before earning before interest, tax, depreciation and amortization. So the upper cap, the interest which you are paying to the non-resident AE will be compared with 30% of EBITDA. That is a thing that we have introduced. The next one, students, is about the countering of harmful tax practice. This is again another challenge. The challenge is that you are doing a research and development in one country, and the outcome of that research you registered in another country, which means that the patent is getting registered in other country. So here is a unique case wherein the research and development, everything is done in one country, and once the outcome is successful, you register the patent in which country? You want to register the patent in that country from where you can earn the royalty income, and that royalty income would be taxed in that country at a concessional rate. So you want to make this country as of the ownership of the patent of that research that you did in another country. You are making the ownership at that country where the tax rate is lower. And that is the reason why, students, they came up with this particular BEPS action plan number 5, which says that rather than your own people doing the research in your country, but once the research is successful, thereafter they are registering the patent in some other country. The reason is very clear. Why they have to go to another country? Because they do know that whenever out of that patent they will earn the royalty income in that country, the tax rate is very negligible, say 10%. So why don't we encourage our particular resident who are doing the research in our own country to register the patent in our country only? What is that incentive that we have to give it to them to register that patent? The incentive that we have to give it to them would be, let the tax rate come to the same rate which the other country is giving the rate. And the other country, the target country in this case, students, was Ireland. Here the target country was Ireland, which I do know very clearly. So the tax rate which was given by Ireland on this patent income was 10%. If the patent gets registered in Ireland, so whatever will be royalty income earned by the person will be taxed at the rate of 10%. So to target Ireland, that BEPS said that you people also come up with 10%. So India also, in fact, we were waiting for it, because India is also a hub of a lot of important research and development activities. So we introduced 115 BBF, encouraging our residents who are undertaking the research and development activities in India. So therefore, whatever, if the outcome becomes successful, then the royalty which is earned from the patent which is registered in India, that royalty income would also be taxable at a concessional rate of 10%, which is on gross basis. Now, how do we know that India was a country in which you have done the research? How do we know that India is a country where you have done the research? We do know that India is a country where you have done the research, because 75% of that R&D activity should be in India. 75% of the R&D activity should be in India. That will tell you that the soil or the country in which the research was undertaken was India, and accordingly, if the outcome of that activity is something which get registered as a patent in India, then the income arising from royalty will be charged to tax only in India at a rate of 10%. In fact, on that front, there is no MAT also. I think all of you may be aware of it now or not. There is no MAT. In MAT also, students, when we will discuss that thing, in that case, you will know that this income is kept outside the book profit. This income is kept outside the book profit. Preventing the treaty abuse. There are two challenges, students, over here. One is that, students, the first challenge is about this kind of a treaty, which like India-Mauritius Treaty, India-Singapore Treaty. One of the biggest challenge of this treaty was that this particular treaty results into a double non-taxation. The Treaty of India-Mauritius and the Treaty of India-Singapore, in respect of capital gains, at least, students, we can say, at least on the income of capital gains. I'm talking about the position prior to the amendment that has happened. Those treaty results into a double non-taxation. Why double non-taxation? Because as per your treaty, you says that the income, the capital gains income earned by a Mauritius resident will be taxable in India. That is what you say. Sorry. The capital gains income earned by the Mauritius resident in India, that will not be taxed in India, but will be taxed in Mauritius. And in Mauritius, the tax rate is 0. So this gives rise to a double non-taxation. Now, how do we address this particular issue of double non-taxation? So the way to address this issue of double non-taxation is that let us now make this as the objective of the treaty itself. So one of the objective of the treaty should be that it is not only that the treaty is entered for the purpose of avoiding the double taxation. This is very good. The fundamental objective of entering into the treaty DTAA is what? To avoid the double taxation. But now we should also provide that the treaty that we are entering should also not result into a double non-taxation. And in this case, students, if you can recall, in the section 90, one of the very important amendment which has been made in the last year Finance Act 2020, that one of the object of the treaty would also be that it will not result into a double non-taxation. This is also that was being specified in Finance Act 2020. This was also being specified, students, in Finance Act 2020. And that is the reason why I tell to all of you students that this is also one of the very important MCQ question. They will give you 2 or 3 purpose, and one of the purpose that they will give you, that the purpose of the treaty is what? One of the purpose would be that people will think that okay, the purpose of treaty is to avoid double taxation. Nobody will give their mind to the double non-taxation part. But now, one of the purpose of entering into DTAA is also that it should ensure that by entering into such treaty, it does not result into a double non-taxation, which was the case earlier with India-Mauritius, India-Singapore. Second issue, which is also being addressed in this particular BEPS Action Plan number 6, is that now people should not do a treaty shopping. Many country or many multinational company does a treaty shopping. What do you mean by treaty shopping? They will analyze a treaty, say for example, between India and Mauritius, and they think that it is better to invest through Mauritius. And then what they do? They set up a particular small office in Mauritius. They registered that particular office in the name of a company so that they can have a bank account in that particular company. And they do what? They put up the funds in that particular company by subscribing to the share capital. And accordingly, the company also gets a bank balance. And that bank balance is thereafter invested to the country of their favorable country of their source. So say for example, the country that they're targeting is India. So they are coming via Mauritius. And what is Mauritius doing? The company which is incorporated in Mauritius is merely a shell company. Shell company means it's a paper company. It's only a paper company. It has got no commercial substance on its own. And therefore, primarily just making a shell company so as to route your investment through that company in India, that is the very purpose or the object of that company. So without any commercial substance, that company becomes a resident in that country, and thereby it is in a position to invoke India-Mauritius DTAA and accordingly take the treaty benefit. Such kind of practices should also be discouraged. And therefore, they have said that it's time that we introduce the LOB clause. And what is the LOB clause? Limitation of benefit. That is to say, the treaty will be allowed to be invoked only if you satisfy the LOB clause. Meaning thereby, you have to prove that there is a commercial substance in you. You have to prove that there is some sort of a commercial substance in you. So unless and until you can prove that, we will not grant you the treaty benefit. So say for example, in India and Singapore treaty, that company, the Singaporean company, has to establish that their yearly expenses is say 20 crores or more, 2 crores or more. So they have to show that there is some commercial activities that is taking place in that particular company, that foreign company is doing that particular commercial activity, and say for example their yearly expenses is 2 crores or more. So as to establish that yes, they are having some sort of a commercial substance. Yes, they are having some sort of a commercial substance and they cannot be considered to be a shell company. And if they cannot be considered to be a shell company, they will be allowed to take the benefit of the treaty. This is what this LOB clause is all about. So the two particular fundamental purpose or the objective of BEPS action plan number 6 is, number 1, students. The first one happens to be, what is the first one? The first one happens to be that the now henceforth the treaty should provide for a clear-cut case of a double non-taxation. There cannot be a case of a double non-taxation because of the treaty. So once a treaty is entered, you cannot have a case of a double non-taxation. That is the purpose number 1. And the second one is that anyone who wants to invoke the treaty, they will also have to ensure that company is having a commercial substance and that company is not merely a shell company or a conduit company, as the case may be. Shell company means, or a conduit company means, a paper company. That is the kind of a word that they have used. Very powerful word that they have used. So tell us that you have a commercial substance, we will grant you the treaty benefit. Prevention of artificial avoidance of PE status. This is also, I think we have discussed earlier also. Like students, if you can recall the agency PE. You remember in the agency PE or even the business connection arising out of the presence of the agent in India. The business connection arising out of the presence of the agent in India. In that, we have said that if the agent is wholly or mainly on behalf of non-resident, is playing a principal role which leads to the conclusion of the contract, then what? Then yes, we can say that the non-resident is having a business connection or a permanent establishment in India. So if that non-resident is having some agent in India which is playing a principal role which leads to the conclusion of the contract on behalf of the non-resident, then in that particular case, we can say that this non-resident is having a PE exposure or a business connection in India. So today we don't see, students, whether this particular agent is actually concluding the contracts in India or not. This has become an irrelevant criteria in today's time. But at one point of time, this was one of the major criteria. In fact, that was the only criteria, that only when the agent in India is concluding the contracts on behalf of the non-resident, only then that the non-resident could be said to have a PE exposure or a business connection in India. Now, because of that, you can know how artificially you are trying to avoid the PE exposure in the source country, which is India, or the business connection exposure in India. How you are doing that? So you were appointing an agent and you were telling that, look, do everything, whatever is required to execute the contract. But at the time when the contract is going to be concluded, like for example, the agreement would be entered, at that time you will move out of the scene and we will enter into the scene, so that you don't actually conclude the contract. And because you are not actually concluding the contract, we will never have a PE exposure or we will never have a business connection in India. And therefore, this was a kind of the ways in which the tax were getting avoided, the ways in which you were successful in avoiding your PE exposure or successful in avoiding your business connection in India. And accordingly, students, they introduced or they substituted with what? They substituted that now we will not look into whether the agent is habitually concluding the contract in the source country or not. What is required would be whether is he playing a principal role which results into the conclusion of the contracts in the source country. So if he is a principal role, that is sufficient enough for us to decide whether that non-resident is having a PE exposure or business connection in India or not. So the principal role versus actual conclusion. Now it is the principal role which will decide, not the actual conclusion, which will give rise to a PE exposure or a business connection in India. And the last point, students, in this entire discussion is the BEPS action plan number 13, which is about the TP documentation, students. I think even this every one of you are aware. Thanks to the BEPS, we have got now the 3 important documents. One is the master file, local file, isn't it? Now this is a standardized approach that they have given, that now the documentation which are so critical in determining the ALP, let across the globe the documentation remains the same. So which are the 3 set of fundamental documents which every multinational enterprise should be maintaining in all the countries? The 3 set of documents are: one is the master file, which gives you the information relating to the group information regarding to a global business operation, transfer pricing policy. So that is what the master file is all about. The local file, which is a transactional detail which are being given in the local file, isn't it? So that is all about the transaction details which we get in the local file. Now these 2 files, should be careful whether it is a master file or the local file. That has to be filed with whom? With the local tax authority. So we have seen that in India, all these multinational company which has got like Coca-Cola India Private Limited, whether Coca-Cola India Private Limited, do they have to maintain the master file? Do they have to maintain the local file? And do they need to furnish it with the Indian tax authority? Yes. What about the country by country report, CBCR? Whether Coca-Cola India Private Limited, do they file the CBCR in India? And the answer is no. The country by country reporting, students, we all know it is to be filed in the tax residence jurisdiction, meaning thereby who filed CBCR? The CBCR is filed by Coca-Cola USA in USA. Coca-Cola USA in USA. And that's exactly what we are doing it. And with that, students, congratulations to all of you. You are done and dusted with the theory, which was a nightmare for all of you. So now I hope that all of you know how to revise this entire theory. Are you aware of this one? How to revise the entire theory, students? Are you aware of that? So the revision of theory, like the overview and the convention of the treaty, how you're going to go about it? 3 parts. One is the definition and the applicability. Second would be the allocation of the taxing right. And the third one would be the 3 special points. One is about the tax credit and the exemption. Second is about the case of the exchange of information. And the third one is about the map. This way you will wrap it up, this particular theory. Second one would be about the interpretation. So one is the 3 things. One is the golden rule, objective interpretation, subjective interpretation. The third one happens to be subjective interpretation, intention of the party. Isn't it? And thereafter the theological interpretation. Theological. What is theological? The aim and the object. From where you will get the aim and the object? From the preamble. Preamble. What about the subjective? Subjective is the intention. What is the golden? Golden is the ordinary meaning, the literal interpretation. And the last one was, in this case, the contemporanea expositio, which was about what? The static approach. The time when the treaty was concluded, that would be the meaning that will be considered. Whereas the ambulatory approach talks about the meaning of that particular word, which is there at the time of application of the treaty. And the last one was, the next one was the Vienna Convention of the Law of Treaties. We have seen that thing. And last was a BEPS action plan. This is what it is. We are done with this one. You should target, students, half an hour maximum to revise this on the day of the examination. Maximum half an hour. Now, how do you do that? I have told you. BEPS action plan 1, 2, 3. Start revising it in 5, 10 minutes. In between, you have divided into capsules in between. Same way now, Vienna Convention and the principle of interpretation. Give 10 minutes for that. In between, every week, just decide once. Do that. And the last is the BEPS action plan. Again, here and give 10 minutes. Not daily. You can give, say, in a 3 days you can do this one thing. And that way you will be done with this theory without any stress, because the day of the examination people come under the stress on this particular revision part of this theoretical part. Okay, so that half an hour, or maybe you don't get time also to revise it on the day of the examination, still it is fine. Because by then it will get registered in your head like anything. Is that clear to all of you students? So do a smart study in respect of this, and that will definitely be a long way to help this particular thing, so that the fear of this particular thing is completely taken out. Is that clear to all of you students? Now students, in this context, I'll just talk about this particular part. Students, this is about Yodha batch, which has been there. This is the Yodha batch about the November 2022. It's a Hindi batch. English batches are also there, for which we have, that is recorded batch in the English batch, which is already there. So this is the Hindi batch. So DT, SCMP and IDT. For the Hindi batch, I am taking for DT, SCMP for Sachin sir, and Mahesh sir for IDT. Thank you, Sunny. Features of this Yodha batch: live interactive classes, unlimited recorded lectures are there, multiple educators for all the subject, doubt solving sessions every week, and practice mock test series. These are some of the top performers who are there, and quite privileged to take them through to AIR 1, 2 and 3 in this regard. Mentor many of the students above. The subscription plan, students, now the recommended is 6 months here for this particular batch. And as you all are aware, students, that if you put up the code CADS, you get an outright 10% discount. So just tell your friends and all students to put the code CADS. So for this batch, the subscription plan definitely is a 6-month plan. And tell them to put the code CADS so that they can get an outright 10% discount on the same. The next, students, one is about the Iconic program, the flagship program, students, of the Unacademy, and the CA Final Iconic flagship program for the CA aspirants. Now, even this is it's a premium program which is there in the Unacademy, and the subscription, students, here goes for 3 particular periods. One is 12, 24 and 36. Now, if you can just see the features against which the price is there, please do recommend to your friends about the same. Depending upon maybe their attempt is in May 23, November 23, they can definitely take these features. So if they are doing only one group also, say for example they do it for 12 months, for the entire 4 papers they have to pay only 28,500 with the following features which I'm going to discuss it right now. And obviously when you put the code CADS, you get 10% discount. So effectively it comes around to 25,000. Now, in that case, students, just see the feature which has been there. One-on-one personal coaching, means there are a lot of LMP programs. Doubt solvers are there, dedicated doubt solvers are being assigned to you. Evaluated test series for every paper, 40, 60 and 40, 80 and 100 marks. For every paper, there are 3 particular test papers which are being there. Printed books are being given, students. So only difference between the Iconic program and the Plus, apart from the other 2 difference which I've spoken about it, is that the printed books are being given. In Plus course, the printed books are not there. Industry expert session Discord is a channel which has been there, and that exactly is the game. So these are the features, and see the price. And that's the reason why students strongly recommended that go for the Iconic, and do tell your friends and your juniors to go for that period. Larger the period, lower is the amount. We have seen that. So let's say for example 24 months. You just see the difference between 12 months and 24 months. It's very marginal. And that's exactly what this particular point is. So that is the advantage of this platform. With that, students, I'll see you not tomorrow at 11:30 AM on the Trust Taxation Revision that we'll do it. The Trust Taxation Revision, students, tomorrow at 11:30 AM. See you then, students. Take care. Good night to all of you. Bye-bye. And please do share this particular video across it. Okay? Like the video, share the video. Now, students, you need to do that. Take care. Bye-bye.